largely been uninfected so far. They are at risk of, developing a new variant anytime there is a surge or basically anytime the virus infects a body, there is a chance for a new variant to emerge. There's that chance that a mutation occurs while it's multiplying in the body. And so that's where the concern comes from, because there's so many cases now. We know that China stopped reporting cases on Sunday, but they've already said that at least 18% of the population has been infected. Beijing reporting that at least half of the population has been infected now, surpassing a previous peak. And other cities, especially major areas, are expected to follow suit in the coming weeks. And they're looking really at that Lunar New Year week when, people are going to be celebrating, when they anticipate yet another surge in some parts. So as you can see on your screen, really concerning images coming from hospitals overwhelmed in the area. And despite the fact that we don't have a clear picture of what's going on, these images kind of tell you exactly what the situation is there. Concerns about the elderly, especially in the area, because they are the more vulnerable population. We know there are concerns about China's vaccine, all really creating a concerning picture. And as of right now, there are no new numbers to report on, but we do know that the country is really suffering through a major surge.
So how are other countries reacting to China's surge in cases right now?
So we know the U.S. has started to require PCR tests for incoming flights. There are other countries like Italy as well, also asking for incoming PCR tests mandatory. Taiwan as well for mainland. Japan as well, putting in emergency measures until starting on the 30th to help mitigate those inbound travelers from China. Malaysia as well, and India is looking at other Asian countries as well, requiring those PCR tests as mandatory. Italy is asking other European countries to follow suit, because right now it's the only one, and we know about the open border situation there. So flashback to 2020, when Italy was the hardest hit country, there's some concerns that without other mitigation measures from those other European countries, we could see another surge there.
All right, certainly a lot of implications to continue to track. Yahoo Finance's own Anjali Kamlani, healthcare reporter. Appreciate it. And switching gears here, Tesla CEO Elon Musk reassured his employees in a company-wide memo that they should not be bothered by the, quote, stock market craziness, unquote, according to reports. Now, this move coming from Musk as the stock heads for its worst year on record. Yahoo Finance's Pras Subramanian is here with the latest. Okay, Pras, what do we know about this memo that went around internally?
So a couple outlets had a letter. It went out last night. Musk thanking employees for another strong Q4. But in the PS section, he mentioned this: don't be bothered by stock market craziness. I believe long-term that Tesla will be the most valuable company in the world, et cetera, things like that. This as the company stock has tumbled, like I said, 70%. Employees who are paid on stock-based compensation aren't exactly happy about this. I wouldn't be either if that was the case. But, employees also are privy to stuff like is demand softening, right? They can actually see that. So they can see that along with, Musk kind of being away from the picture, being out in Twitter land, doing what he's doing over there. So, they kind of see what's happening. I think Musk finally addressed this to his employees. I mean, just in a little small PS at the bottom of a note. So
after he sold more than $20 billion worth of shares.
Exactly.
And it is interesting to see Tesla up in the pre-market now up 7%, still reacting, I would say, still responding to positive comments by Musk there, according to that internal note. But you also have Adam Jonas out here this morning, longtime Tesla bull. He's out here slashing his price target to $250 on Tesla, which still assumes about 117% upside. But another name on Wall Street cutting these price targets into year end. And to me, Pras, I think these targets are still absolutely ridiculous. It's not just Jonas and Morgan Stanley.
Yeah, I mean, there was another, I can't remember the bank, but they had a 300 something target, went down to 2 something. I mean, it's still half what the stock is right now, right? So it's funny, they're cutting targets but leaving their rating the same, right? So I think it sort of implies that they still believe in the long-term story of the company in terms of what it's doing, how they're going to sort of replenish the entire world's sort of population of gas-powered cars, along with Tesla among others. So I think they see that case still intact. It's the question of short-term what's going on.
A lot has to go right, though, for Tesla. Right out of the gate next year, the China production has to kick back into gear. Sales have to reaccelerate. Profits have to stay strong, potentially in a recession. Pras, these targets are absurd.
Yeah, I mean, if anyone can do it, we've seen Tesla do it before. They have the ability to make a lot of cars, and they can make them actually cheaper with better margins than other manufacturers so far. But we'll see. I mean, like I said, VW, GM, Ford, they're going to catch up. And I think that's the real reckonings next year in 2024 how are they actually going to maintain their dominance?
And that was what was interesting within some of the Edmunds data that had come out from Edmunds Research, really looking at where some of that attention, or at least mind share, is gravitating towards with regard to the EV buying experience. Is there, with the number of new competitors, and not just new competitors in the automotive landscape, but in the EV space specifically, legacy automakers that are now have ramped up that production and have some of the name equity in some of their existing models that they're now electrifying? Is there a shift that we're seeing right now in the consumer mindset?
I mean, we see the Fords that are trying to go online, trying to buy cars, and they're still not there yet. Tesla, I can order a car on my app right now and get it next week. The question is service after that. How do I get the car service? They're not really good at that part. But they can sell the car. They have plenty of supply. GMs and Fords, there's not enough Ford F-150s in the lot yet. I mean, there's not enough of these cars yet that we can buy. So I think that's a big problem right now for people that are waiting for the Silverado EV, the F-150 Lightning, stuff like that.
Professor Mania, appreciate it. Thanks so much. All right, Goldman Sachs CEO David Solomon says the company is working on a fresh round of job cuts that will happen in just a few weeks, citing the slowing economy's impact on the business landscape. The firm could cut up to 4,000 jobs, or 8% of its workforce, a source tells me. And Brad, of course, this comes against the backdrop of really a downturn this year in investment banking and other parts of the investment banking field. You have Morgan Stanley earlier out this month saying it would cut 2% of its global workforce. That equates to 1,600 jobs. In the third quarter, you had deal volume down 36% in terms of volume, 64% down in deal value. So of course these cuts are going to come. And now who's on the clock? It's a JP Morgan, it's a Bank of America.
Yeah, according to the reports and Bloomberg noting this, the headcount reduction going to take place in the first half of January, and variety of factors impacting the business landscape, Solomon adding, including tightening monetary conditions that are slowing down economic activity, and then additionally looking at where those positions could potentially be cut at. They've spent a lot to get into consumer banking. You wonder if at a time for a company that is going to be looking out into next year and the year after, we've continued to hear about this kind of headcount hoarding in order to really brace for the wave of new deal making that may come forward in terms of 2023, and how that pipeline could open back up and what Goldman Sachs would need to really work through that deal demand. So does that mean on the consumer banking side, where you've already invested a ton of money, that you look at some strategic cuts, or does that mean that you stay the road ahead at this point? So it'll be interesting to see where some of those cuts actually come forward next year too.
Right, and really you get the sense that the stage is being set for a powerful rally in these bank stocks at some point next year. We're not making stock predictions here. We don't recommend buying or selling stocks, but you have likely several more rate increases from the Fed, usually good for the profit margins of banks. You now have what looks to be deep cuts in the workforce of some very high paid positions at these banks. And if we do not get a recession, you theoretically should see a resumption of deal activity. I can't imagine you're going to see the same type of plunges in deal volume that you saw this year. So those are all the factors that at some point could support some really nice bounce backs in these stocks.
Yeah, this would be about 3,900 employees based on the headcount that they've got as of this year's third quarter of 49,000. And so that is a significant cut that we would be looking at across Goldman Sachs. And depending upon the divisions, we'll see if there is any more detail that makes its way into the public's eye. But the workforce certainly has grown even since pre-pandemic times. And now looking at a cut of this magnitude, it just makes you wonder where we might see even more of the banks start to roll back, not just on their hiring or the hiring freezes, but then additionally on just where they're prioritizing headcount allocation in this near term too.
And then the other question too, Brad, is where do these folks go? When there were layoffs on Wall Street, perhaps these folks would go to a second tier investment bank, let's say a Jefferies, great bank in its own right, but again, not, I would argue, on par with the Goldman Sachs. If you get laid off at Goldman Sachs or JP Morgan, where would you go? Also, tech. Well, tech is canning everybody.
And they've already made their cuts.
So they're not hiring either. So it'll be really interesting to see how this plays out.
We'll continue to watch that very closely and keep a close eye on shares of all of those companies in the banking sector. Coming up on the other side of this short break, our next guest is bullish on the market in 2023, but not so much on the economy. We're going to discuss that next. The Fed's fight against inflation yielding some visible results, but it is also setting up the market to anticipate a pivot earlier than expected. The lagging effects of rate rises plus sagging employment could mean a good outlook for markets, but maybe not for the economy. Joining us now with more, we've got Joshua Wine, who is the Hennessy Fund's Vice President and Portfolio Manager. Great to have you here with us this morning. Break down your thesis for us. Of course, we know that economy, markets, not the same thing, but both of them very much are in reaction to the Fed's policy pathway that is continued to be put forward here. Do you expect that we'll see any type of pause or a pivot in 2023?
Sure. Good to be with you. Good morning. Yeah, I think that, the last year has been, whether it's good economic news or bad economic news, the Fed was going to raise rates. We all knew that, and they did. They raised several times, 75 basis points, and now we're in a phase where it's 50 basis points. I think that the back half of 2023 will look a little bit more normal from the perspective of bad economic news could be good market news, to the extent that the Fed either pauses, pivots, maybe cuts at the end of the year if the economy indeed slows as much as many expect, and certainly I do as well.
Josh, what changes to the portfolio or portfolios have you made in the last week of the year?
We haven't made any changes. So we're incredibly disciplined by design. In the Hennessy Midcap 30 Fund, we are looking at earnings growth, valuation, stock price momentum. We have not made any changes of late. Continue to remain invested in energy, consumer discretionary stocks, industrials. No changes.
What happens to those stocks if there's a recession next year?
I think that it might not be bullish for their top line, their bottom line, but I think that the bigger picture isn't the next 12 months for any company in particular. I think it's more the outlook for interest rates and the effect it has on the present value of future cash flows. So I think that, I think the thesis behind, being bullish on the market largely is to some degree what you were all just talking about, which was Tesla and many other stocks that have taken it on the chin. And I think that kind of reversing of the wealth effect, we saw an incredible bubbling up in the economy around new home purchases and auto sales and the like. I think that largely reverses. Some of that is the decline in home prices, lower activity within residential real estate, and ultimately commercial real estate, which we'll see coming up as fewer people work in offices. And also just the market. The market's down anywhere from 10% on the Dow to 30% plus on the Nasdaq. And I think that perceived or real feeling of wealth that people have had has started to dissipate. So I think that, the economy slowing down is not a big stretch.
Next year, it seems like it's going to be a year where companies themselves need to tap some of their cash balances and perhaps quite considerably as they navigate whatever a recession does look like. And of course, they've already instituted some of the cost restructuring that they can right now. But what type of cash crunch do you think we may see across equity market companies as they begin to report next year and really get into the throes of a recession?
Yeah, that's a great point. I mean, I think that, broadly, the S&P 500, there's about just over $7 trillion in cash on the balance sheet of S&P 500 companies. I think looking through that number, because certainly some of that cash is the result of raising debt in the market or taking on loans. So net debt, is in good shape, especially when you contrast that with operating cash flow. So, this past year, you're looking at that relationship and it's quite strong. So of course, operating cash flow could start to weaken in a recessionary environment. But I think the larger point is that it would have to weaken quite a bit for there to be any kind of liquidity issue or any kind of talk, real talk about companies struggling to make ends meet. Capital markets are still alive and well. I mean, we've had a lot less deal activity than in the past. And I would also say that, interest rates have backed up quite a bit. But, we're nowhere near a 1980s scenario where, people are paying double-digit interest rates on borrowing. So I think where we were was artificially low. I think things are starting to look a lot more normal now, notwithstanding an inverted yield curve and certainly, interest rates well below where inflation has been of late.
Given all the concerns out there, Josh, what sectors do you really hate?
Really hate? I can't say I hate anything. I mean, I think that, there are certainly names, I think large cap tech, it's hard to get a handle on earnings expectations. And so, with a name like Tesla, it is interesting that the multiple, the forward multiple is starting to look, somewhat normal and perhaps attractive. I think what is problematic for names like Tesla that have, come on the scene very quickly and even to date don't have that much competition. It's just hard to get a handle on where the earnings would be next year and beyond. I think that there's not a lot of stability there. Same thing with kind of your classic social media type stocks or advertising revenue focused stocks. It's just hard to know what that looks like. The multiples are starting to look more attractive, but I have a hard time getting some clarity around where things might look.
You mentioned that you haven't made any significant changes to your portfolio over the last 2 or few weeks going into the end of the year and the start of 2023. But if there's one trade that you hope to be able to initiate and the factors that would set that up in 2023, what would that be?
I don't think there's one trade. I mean, I definitely would not want to be heavy in cash as the Fed starts to change their language and people start to see their way toward the idea of a Fed cut. I mean, one thing that is interesting about this rise in rates of late is that now the Fed has something to do if there's a legitimate recession, if there's a shock to the system. So, they might not, quantitatively ease, but certainly a rate cut is in the offing, maybe later in the year. In terms of a trade, I would put out just some names that kind of fly under the radar. Super Microcomputer, which is in our Hennessy Cornerstone Midcap 30 fund, trading about 8 times forward earnings. They are a distributor and manufacturer of servers and storage equipment for large corporations. Not terribly sexy, not very exciting. I don't hear anyone really talking about names like this, but I think Super Microcomputer is interesting. And then also in the commercial and industrial packaging space, Sunoco products. A nice about 3% dividend yield that's growing, 10 times forward earnings. Very stable business. Don't see, much that, makes this hard, kind of to hold on to for the long term. So I think that names like that, especially when, we get into a more normal kind of Fed environment, more normal inflationary environment, and cooler heads prevail, I think these names are set up for a nice run.
Yeah, I never heard of that. Supermicro, good call out there. Josh, I'm going to spend my weekend checking in on that one. Joshua Wine, Hennessy Funds Vice President and Portfolio Manager. Have a Happy New Year. Appreciate it.
You too. Happy New Year.
Straight ahead, meme crowd favorite AMC in focus after a smackdown from one rating agency. We have the details next. Welcome back. While we await the opening bell on Wall Street, let's dive into a few hot Yahoo Finance ticker pages. First up is AMC. Surprise, surprise, as the company hit a 52-week low, closing Wednesday $3.84, down from $21 in March. And Brad, this comes as S&P. I'm just shocked by some of these comments. S&P showing it has a pulse in its research, saying, in our view, AMC is pursuing this transaction, of course, that debt for equity transaction we reported here last week, because its capital structure is unsustainable and has limited options to reduce its debt burden and improve its cash flow. That type of aggressive commentary you do not usually hear from an S&P, but the fact that it did come out with it at a time where AMC shares have been under considerable pressure, I think is noteworthy.
Yeah, and this really in reaction to some of their debt reduction plans. And look, for AMC, the year is perhaps not exactly what they had framed it up to be, especially on some of the blockbuster releases that had come out in the content schedule. And now, looking out to next year, I mean, what really is going to be able to kind of lift the tide for a lot of that movie-going experience where we already know so much of the fanfare around some of the most viral titles? It continues to still be around titles that you can stream right now, or titles that make it to streaming that much faster. So what is the draw for somebody to say, you know what, I'm going to pay up, I'm going to buy an overpriced concession that's probably hyped by about 400%.
Look at that popcorn though, Brad.
Yeah, that popcorn could cost
really
you $2 in store.
AMC's coming out with that in the store now.
Probably $10 at the movie experience, 14 probably. So, I mean, all that considered, in a recession where people are going to be looking at their discretionary spending, if there's one area that they're going to look across the experiences dollars that are going out the door or out the window in this case, then that movie theater experience might get pulled back tremendously. And so what does that mean for AMC, even in some of their own plans to prop up the movie theater experience and bring back some of the moviegoers through any type of Stubs membership or subscription service in the future?
Brad, I agree with most everything you say. I got to push back on the movie theater experience. I saw Top Gun over the summer. I went in there.
But you're a big Top Gun fan.
But I saw it in a comfy reclining seat. Had a big giant piece of box of popcorn. It was just a great experience. I mean, the chairs. I was able to lean back. I put my soda right here, Diet Coke. It was great. It was great. I can't do that at my house.
It's a bad experience.
I can't do that at my house.
It's just not an attainable experience for what, $90 for the family? You know how many months you could pay for a streaming service for $90?
That's
you
true.
might be able to buy Disney Plus for like a year on that.
Well, you're coming at it from the family aspect. I'm talking about it from the single guy who went to go see Top Gun by himself.
And you
so it was a
paid
cheap experience for me.
$25.
Yeah, it was great. It was awesome.
Yes,
never,
exactly.
Never better.
That's 3 months on any subscription service. Let's also talk about Cal-Maine Foods, ticker symbol CALM. Everybody remain calm this morning. Shares are down by about 3.5%, though. Not great. This morning, after the egg producer posted earnings for the second quarter, failing to reach estimates on the bottom line, but the company did top revenue expectations as sales more than doubled, increasing 110% year over year. As egg prices, it's the egg prices here, they continue to rise. They also did note that they're tracking something really interesting, which is this kind of outbreak among commercial flocks recently occurring during each month from September to December of 2022. And so that is an epidemic that is impacting the supply as well. In the
I got to shoot these guys an email, Brad. I don't know why their ticker symbol is common. It should really be egg, or it should be CHKN. I mean, why are you making it all so confusing? It should be one of those two. You're the largest egg producer in this country. But I spent about 25 minutes this morning reading their 10Q, which is their more extensive quarterly report than the 8K. Very interesting read. The average selling price per dozen for eggs in the quarter, $2.71 compared to $1.37 last year, Brad. Real big uptick in the price of eggs benefiting this company. Now, on the flip side of it, because they had to produce more eggs, they saw an increase in feed costs, which took a bite out of their bottom line.
Ooh, all right, interesting there. So there's this other thing too. I mean, when we think about airlines, I always talk about some of the alliances that have come about to make servicing certain routes. This is the best full screen.
That sums up my entire year right there.
Look,
just one single photo of an egg.
Just, yeah, 2022, the year of the egg. My
Who
goodness.
put that up there?
I know,
Come on.
seriously.
I mean, I know it's holiday season vibes, guys. I mean, wow. Single leg photo.
So here's the interesting thing, the thought frame or path that I was on here. As you think about some of the alliances that have come about to really make it more interesting to serve or easier to serve certain industries. In the egg side, there's this new pro-egg cooperative. As I'm trying to remain serious.
Can we show that one egg photo again, guys, while Brad's talking, please? Come on, guys. Come on. There we go.
The pro-egg. This is the pro-egg cooperative here. It's going to be providing some benefits for its customers, but it's really some of the leading egg production companies across 13 Western states. So perhaps this can help them on an efficiency standpoint. All right, just toss the egg back.
I thought that was an Elon Musk planet right there. I didn't know that's an egg. That's an egg, man. It looked like Mars there for a second, Brad. It looked like Mars.
That looks like Mars.
Yeah, I would pay more to go to the movie theater if they sold some of those at AMC. Maybe some egg whites scrambled.
Well, that's probably what they need to do. They need to serve more eggs at the theaters.
Wow.
More morning matinee movies.
That was epic. Wow.
Thanks.
I miss Julie. All right, there you have the opening bell here on Wall Street on this Thursday, almost Friday, but hang in there, folks. Today is, in fact, Thursday. We have that opening bell on Wall Street as investors look to just, figure things out as they get ready to turn the calendar year into 2023. It's been a very challenging year for tech. Some stocks we've been watching. Apple fell below key support levels yesterday. You saw a big pre-market move in Tesla off the Adam Jonas overweight recommendation reiteration. That stock was popping about 7%. Brad, over to you.
Yeah, if you were looking for gains in your 2022 portfolio that you haven't seen at this point yet, well, I'm sorry to let you know, you're probably just not getting it right now. But taking a look at where we're seeing some activity here on the day, over the past 2 days, still net lower by about 0.6%. Higher, though, out of the gate this morning. We're up by about 0.5%. Nasdaq Composite, you're seeing that open to the upside by about 1% this morning. Past 2 days, and we'll kind of put this in a week view, if you will. 4 days still down by about 1.5%. And then additionally checking in on the S&P 500 here, you're seeing that higher by about 0.7% here. Still net lower for the week, but we'll see if we can close out on a strong note perhaps later on today. We've got a lot of trading session left here. We're just about 1 minute in. And then, of course, we've got tomorrow to really end out this year that 2022 has been. Let's take a look at some of the sector activity as well here off the jump this morning for the 11 S&P 500 sectors there. You're taking a look at XLY leading the pack here today. You've got some consumer discretionary leading the way. We're up by about 1.2% there. However, energy, rare day where that's bringing up the caboose. It's down by about 0.2% right now, but of course it's been one of the outliers over the course of this year. In fact, the outlier, it's up by about 54% year to date. You compare that to the rest of the market, not even close. Sals?
All right, let's fly into a sector that you, of course, follow very closely there, Brad. Shares of Southwest Airlines continue to be in focus in the midst of one of the worst weeks we have seen in terms of cancellations and delays. Over 60% of Southwest flights canceled yesterday, and already 50% canceled so far today. Brad, we were talking about yesterday, I believe Julie mentioned on the Citi note impact earnings by 4 to 8% in the current quarter. But now as these delays continue, you have to wonder, can this impact to earnings this quarter be even worse? And then like we also mentioned yesterday, what is the longer term impact from really letting down just tons and tons of customers here at such a key period?
Yeah, there's a customer sentiment impact, and perhaps that would be seen most notably on a metric that you can track in their Net Promoter Score. But outside of that, on another metric that you can track on a quarterly basis, it is going to be their earnings and what that profit actually looks like. Now, we had a guest on yesterday tell us that it could be hundreds of millions of dollars in impact to their bottom line for this quarter. And it's more than just some of the weather delays that we were discussing. Of course, that really initiated or at least elucidated some of the issues with their underlying software that they have to track the employees and the crew that are making their way from one city to another in order to make sure that flights are staffed. And we were just looking at the FlightAware tracker before this block started, and it's amazing to know, number one, how much traffic control has to take place for the number of planes that there are on a daily basis here in the US and internationally to be in the sky. But now you think about the fact that over the past 2 days, we've seen 2,000 flights canceled by Southwest. That is multiples higher, actually exponentially higher than a lot of the other US-based air carriers. And so as of right now, even today, still more than 2,300 flights canceled, and Southwest still has a lot of explaining to do, even to the administration, as Department of Transportation Secretary Pete Buttigieg continuing to take them to task.
Yeah, and I ripped them apart yesterday, CEO Bob Jordan and even Chairman Gary Kelly, longtime CEO, and I think it was, Brad, maybe yesterday afternoon in a journal article, the CEO, or maybe it was Bob Jordan, escapes me right now, saying they had talked about earlier in the year investing more in technology. Well, you should have did it. But now you would probably not be in the situation if you were investing the money you were supposed to in CapEx in your technology to prevent a situation like this. So again, I think it's just a bunch of executives and a board trying to meet an earnings number in a challenging year instead of thinking about the next decade for this company.
Well, it was part of the issue that I brought up yesterday too, is that if you're looking at where they did invest, and instead of investing in what should have been an overhaul of the technology that they were using to track exactly where those crew members are, they invested elsewhere, and for some of those investments, it goes towards fleet. For some of the investments, it goes towards just making sure that you've got pilot training that's going forward as well, and pilot shortage, and to address one of the pilot shortages that has impacted the ability to bring capacity back online, which, by the way, capacity is not going to be back at full restoration for Southwest until the end of 2023, based on what they have said. And so now you're looking at them building on top of a system that is clearly been broken, but they have not invested to fix. So it really brings the question once again of, will they actually get back to full capacity? If they have to look at that technology specifically, uproot that, install something else new, and then build on top of that to bring back up to the full operating procedure that they had seen even pre-pandemic. And I just don't know if that actually is a metric, or at least a timeline that is still accurate at this point.
And a lot of times you see during situations like this, other executives, everyone wants to play nice. But if I'm Ed Bastian at Delta, I'm Robin Hayes over at JetBlue, I'm using this opportunity, maybe perhaps send an op-ed into Yahoo Finance. Tell your investors, speak directly to your investors on what you do differently than a Southwest. Because right now, this is a huge market share grab potential for companies like that, as this company likely continues to struggle deep into 2023.
All right, we're going to continue to track the airlines. You're taking a look at a few of the stock reactions here on the day. AAL up by about 0.7%. UAL, American Airlines, or United Airlines, excuse me, up by about 0.9%. We'll continue to keep an eye on those. On the other side of this short break, we've got Yahoo Finance's Jared Blickery going to break down the latest market action as we close out the last 2 trading days of 2022. Welcome back to Yahoo Finance Live this morning, everyone. Major averages in the green across the board. Let's get to the positive gains party with Jared Blickery over at the Wi-Fi Interactive. Jared.
Welcome to the positive gains party right here. Except let's check out over the last 3 days, because this is day 3 of the Santa Claus rally. Finally comes to conclusion, the second trading day of the new year. So got a few more of these left. Guess what? The Dow is underwater just a little bit over the trailing 3 days. S&P 500 up 1%. It's underwater by 0.5% over this time frame. And the Nasdaq, well, it's down by 1.35%. And I just want to show you guys a chart of the Nasdaq here. This doesn't happen very often, maybe never, but the ultimate high, the record high in the Nasdaq was actually the first trading day of the year. The lowest trading day of the year, at least in terms of settlement, was actually yesterday. So that would be pretty interesting to bookend the year, a year like this, with the highest price and the lowest price, pretty fitting for this year. Doesn't really mean anything, just thought I'd bring that up. Now, here's the Bank of America Move Index, or excuse me, B of A ICE Move Index, and this is heading up. Let's put the candlesticks on so I can show you. There we go. This bar is as of the close yesterday. Didn't have a really big day in the bond market, so not reading too much into that, but also want to check out the U.S. dollar. This is a 3-month chart of the Dixie, and the U.S. dollar has been holding ground here. If it were to dip below, that would probably spark a nice risk-on rally. The dollar has kind of been wagging the equities tail all year round, and now it's time to get some heat maps here. So this is the sector action for today. Everything in the green, consumer discretionary, tech, communication services, all the mega cap sectors, those are in the lead today, followed by materials. That's outperforming as well. The S&P 500, they're up 1%. So all of these are outperforming. To the downside, staples, energy, and financials, those are still all in the green, but those are taking up the rear. Want to show you what's happening with our leaders. This is a stark contrast with what we were saying the other day, actually just yesterday. Lots of green there, but when you take a look at the 3-day Santa Claus rally, not a lot of risk to be seen here. So we'll have to see how this pans out over the next few trading days, guys.
Jared, you want to come with me and Brad? We're going to do a positive gain session at the gym later. Ready to rock? Maybe a little pre-workout.
What time?
My man. You're the best. Jared Blickery, thanks so much. All right, the Nasdaq is now down about 10.7%.
Man, that's what time.
In December, if the decline, Jared, 5 o'clock. If the decline's hold, it will be the Nasdaq's worst December on record, points out Bespoke. The Nasdaq saw a 9.7% drop in December 2002, a 9.5% decline in December 2018, and a 5% pullback in December 1974. Coming up, Citi is out with a bullish note on Apple as the tech giant stock continues to be under major pressure. We have the analyst making that call straight ahead. Apple shares are down nearly 30% year to date as big tech has taken a beating this year. But our next guest is listing 6 reasons why Apple could be poised for upward momentum in 2023. City Managing Director and Senior Analyst Jim Suva joins us now. Jim, always great to get some time with you. At these valuation levels, is Apple just too silly cheap?
Brian, we believe so. That's why we have a $175 target price on it with a buy rating. We knew that the December quarter was going to be difficult given the supply chain issues. Look, if you wanted to buy an iPhone 14 for Christmas, they could meet that demand. They were sold out mostly because of supply that was curtailed from China. We have now seen, as you know, the importance of consensus expectations come lower. We were below consensus. Consensus has been moving lower. Now we believe a lot of that demand is going to be set up for a more stronger 2023. Yes, we like the stock here at these levels.
Jim, one of the reasons that you gave was India, specifically looking at the total addressable market in one facet, but then additionally, just the amount of market share that Apple could potentially take on there. And this, we should note, the mobile operating system market share in India is essentially 95% Android operating system. So what is it going to take for either the conversion and perhaps some of that market share take to come Apple's way? And what does the unserved market look like in that region?
So, Brad, that's a very smart and intelligent observation. Many people may not be familiar to note that, a decade ago when we were writing about Apple and China, we kind of noted that it was the same type of dynamics. And people were like, oh, the affordability of household income isn't there. And we're like, as China matures and develops as a country, we believe the same thing's going to happen with India. It may take a while. Importantly, as you import items that are produced in China into India, there's an import tax that makes then the iPhone and Apple products more expensive. This then hurts the demand for it. Importantly, Apple is setting up manufacturing in India. We believe that will help. There are 0 Apple stores in India today, none. You're fortunate in New York City and me in San Francisco to have Apple stores on a regular basis. It's a great experience. You go in, you think you're going to spend $600 or $700. You leave by the Apple employees convincing you that your friends and family are so beautiful and handsome. You need to buy more memory, Apple Cloud, and Apple Care. And then you walk out actually feeling good about spending more money. We believe next year that likely Apple is going to open its first India store and Apple store in India, and this will be huge, a lot of demand. We see India as a big driver where they have below 2% market share. So to answer your question directly, Brad, we believe once they set up production in India, they won't have to pay the import taxes. Then they'll be more price competitive. And then importantly, we see the Apple stores opening up as a great experience for consumers.
Jimmy just reminded me I need to go pick up 2 new high-margin phone cases from Apple later on, so thank you for that. But you also talk a lot in this report about new products, specifically an AR VR headset. What will Apple be doing here? Because I think the argument can be made that the glasses, the Oculus glasses that Meta have been a complete flop. They've just been too expensive here. What do you think Apple's going to do?
Many people who've followed Apple for a while kind of always knock them on not having the highest end, most newest physical technology. The reason why is they focus on the infrastructure and the entire operating system and the full experience of when hardware and software meet each other for a great consumer experience. What have they done? So far last year in June of 2022, or 6 months ago, they came out with their AR kit, where it allows teachers, educators, pilots, trainers, and a lot of the technicians and architects to build AR VR kits. So when you walk into your kitchen and you want to remodel it, or you're trying to go to pilot school, and instead of actually going on an expensive trip or a doctor, you can actually see the cadavers and the surgery in a more real life experience without being there in person. They are now building the ecosystem. We believe building the ecosystem is critical to the success of that, and they have indeed been building out that ecosystem. So that's why we see now the hardware coming out later this year as a beneficiary and a positive, because so many of the infrastructure has been building those apps that will then make them more applicable for a real reason to buy the product.
What type of attribution do you believe that AR or VR could have to its services business?
Well, right now it's going to be de minimis, but when there's so much negativity around Apple not keeping up with other products, we view coming out with it will be a positive. We also believe in a year from now, we'll be talking about a foldable phone. Hey, won't that be great? Where on the top screen, I can be watching Yahoo Finance, and on the bottom screen, seeing the emails that you're actually emailing me about when I'm up on the next commercial. That will be a great experience for people. We believe flip phones or foldable phones with two screens that operate independently are going to be a big driver. The ones that are out there today are actually being received very well, but Apple wants to make sure that crease or that seam in between isn't faulty or create a suboptimal experience. So yeah, we expect AR VR to be a positive headline. It really won't move the numbers tremendously, but people will say Apple is still innovating, whether it be these AirPods or Apple tags when you lose your luggage, and I'm glad we're not traveling today. Those are type of more innovations that we see, and they eventually add up to a strength of an ecosystem that makes the reason why you want to go into Apple iOS more and more compelling.
Jim, I hear you're going to be at CES in about a week. Yahoo Finance, of course, is going to be there as well. From the big cap tech names that you cover, who do you think will have a home run CES?
Well, first of all, it's important to note Apple does not attend the Consumer Electronics Show in a public manner. Apple hosts its big event in June called the Worldwide Developer Conference. The companies that we do expect to be there are your typical PC and consumer electronic companies. We expect to hear about Christmas demand, how it was. And look, we expect it to be kind of soft. Unfortunately, people were stuck in airports. People were stuck on the road with adverse travel. People were stuck with snowstorms. And with inflation, let's say Santa Claus had just a little less money to spend this year. So we expect people to be a little bit more interested in the innovative products that will be announced. We don't know what they are until they come out, but they will be announced at CES next year. And we're looking forward to seeing your team there.
All right, Jim. Flat screen or foldy screen, I'll still find a way to crack it for sure. City Managing Director in Equity Research, Jim Suva, joins us this morning. Thanks so much, Jim, and Happy New Year to you as well.
Thank you so much. Happy New Year, y'all.
Thanks. Coming up, 2022 is wiping out all of Disney's pandemic-era gains. Sazi is going to share his take. That's coming up next. No magic in Disney shares this year. The stock is down over 40% and recently hit the lowest price since before the company released the Star Wars collection. The decline for the House of Mouse is where we find Sazi's take today. Saz.
Yeah, I'll hit the high notes here. Our media reporter, Ali Canal, has been all over this Disney story. I would encourage you to just go read her work. It's absolutely awesome. But yes, the stock is really starting to come under pressure here. First up, as you noted, Brad, the stock is below the 2020 low. Really not good. There I am, my trademark Mickey Mouse ears on there, probably holding an egg on my left hand. The stock of Disney down 46% year to date. And interesting here, Brad, is that shares of Disney are down 8.3% since Bob Iger's return was announced as CEO on November 20th. Not what you initially got that pop, but the stock has been losing ground ever since. So here's why I think you're seeing some of these declines here. We'll run through them very quickly. First up, no easy fixes for Disney. This view that initially caused that Bob Iger pop when he was announced that he would come in, fix everything overnight, and Disney would be back to re-accelerating earnings growth. That's just not reality. Disney's up against a lot of problems. Number two, what does future leadership look like? Bob Iger only signed on for 2 years. It's up to him to finally get the correct successor in place at this company. Three, what is the fate of ESPN? Ali was reported, I believe, last week, some whispers on Wall Street of a potential ESPN spinoff. That was from the team over at Wells Fargo. Interesting read there as well. Next up, how will a recession impact the parks performance? The parks business really has funded everything Disney has been doing the past year and a half in terms of streaming. But if there's a recession, best believe people are going to be pulling back and not spending thousands of dollars on a Disney vacation. And then speaking of streaming here, you have to think, when have streaming losses have peaked? Have they peaked just yet? I believe the company lost $1.5 billion in their streaming business in the last quarter. Really shocked the hell out of investors. Next up, no blockbuster hits this year. See Avatar, certainly ringing up its fair share at the box office, but missing expectations, I would argue. The dividend for Disney is still suspended. They suspended that during the pandemic. And how deep are the cost cuts here, Brad? That has been all eyes here on what Iger, on how deep he cuts in terms, how deep he cuts on costs just to improve the company's bottom line. And speaking of Iger, my take here, it's time for some Iger magic out of the gate. Bob Iger, of course.
That's a good hat.
Wow. Of course, Bob Iger knows his business very, very well. I think he's been spending the past few months since being announced really digging back into the business, refamiliarizing himself. I believe he recently traveled to the ABC newsroom on One Bureau. And now, realistically, coming out of the gate next year, you're going to get more clarity on his plan. First and foremost, how much is he going to cut from this business in terms of cost?
One, appreciated the Fantasia hat.
Me too.
Number two, I think with everything that you laid out, I mean, it's spot on. Obviously, the huge issues that we've seen for right now in terms of how they're forecasting and how they're modeling going into next year is everything that has to do with pricing, whether it's pricing for streaming, whether it's pricing for the parks and resorts experience, and making sure that you're not churning any of those customers that have finally come back into some of those folds, especially on the resort side, given the lull.
Oh, returning egg photo from our CalMaine discussion. There it is. That is the true star of this show. CalMaine, really big quarter for that company. But Brad, it was an interesting study. Oh God, come on, guys. It was an interesting study. I forgot who put it out. People are going into debt to go to Disney. No, you cannot go into. You cannot put yourself $10,000 plus in debt to go to Disney.
I thought they had a timeshare package or system set up.
It all sounds expensive to me.
Yeah,
all of it, every single bit of it, even that egg.
Well, the eggs are more expensive. Guys, coming up, why our next guest is now forecasting a mild recession in 2023. We're going to discuss that, plus where eggs factor into the mix next.
Welcome back to Yahoo Finance. I'm Brian Sazi alongside Brad Smith. Julie Hyman has the day off. Markets will try to rally after a sharp negative reversal on Wednesday. Right now, well, they are in fact rallying. We're seeing green across the screen. Here's what's on tap this hour. Doing some tech shopping, veteran tech analyst Mark Mahaney stops by with his biggest calls for 2023 after a tough year for the entire space. And not a fun experience. Six Flags continues to get pummeled by Wall Street for its poor performance. We'll serve up some fresh analysis on the theme park operator. And to divest or not to divest, that will be the question in 2023. We'll chat with an expert in deal making to see why big companies may look to shrink next year. Brad, over to you though.
All right, we're taking a look at some of the major averages here this morning. The Dow Jones Industrial Average, as of right now, just about 32 minutes into trade, is up 0.8%, 250-ish points added on the day. You've also got the Nasdaq Composite squarely in positive territory. That's up by about 1.8% here. And let's take a look at some of the activity and the chart here, perhaps intraday. Yeah, we're just off of some of today's intraday highs. We'll continue to track that very closely for you. And the S&P 500, you've got that up by about 1.3%. So some solid green activity here early in today's session. We'll see if we can end the year out strong, at least for these last two trading sessions of the year. Taking a look at the Nasdaq Composite and some of those components. Yeah, everything is in positive territory, essentially. Let's put this on an equal market view. Yeah, exactly the case there. Tesla leading the pack. That's up by about 6.7%. You've also got some of the other EV companies, Lucid and Rivian, all of those up on the day. And then just lastly here, I did want to take a look at some of the crypto stocks catching a bid here on the day too, and some outperformance here. You've got shares of Robinhood. They were moving higher a moment ago as I was tracking those by about 3.4%. And then additionally Square, Riot Blockchain, and PayPal, they're also handedly higher here on the day. So we'll continue to keep a close eye on those. And as we continue to count down the days to the new year, our next guest says a mild recession is coming in 2023. We're joined now, by Gus Fauché, who is the PNC Financial Services Group Chief Economist. Gus, I was putting all the green up on the screen, trying to tee us up for a really positive and bright conversation, but you're saying mild recession is coming in 2023. What gives?
Yeah, that's right. I mean, obviously, we've seen a big increase in both short-term and long-term interest rates throughout 2022. We're already seeing a significant contraction in the housing market. And I think we're going to see a greater drag on consumer spending on business investment from those higher rates. And that will lead to a mild recession, probably starting sometime in the spring. But it should be more similar to the recessions that we experienced in the early 1990s or the early years of this century, rather than either the Great Recession from 2007 to 2009 or the COVID recession.
Gus, is the housing market collapsing?
It is contracting very, very quickly. So we've seen housing starts. We've seen existing home sales fall by about 30%. We're starting to see house prices decline throughout the nation. I mean, that's not surprising given that the 30-year fixed rate mortgage went from below 3% in the fall of 2021 to up close to 7% now. Affordability is a big issue. This is what the Fed is trying to do. By raising interest rates, they're making it more expensive for potential home buyers to borrow. That slows economic activity, and the Fed is trying to cool off economic growth in the hopes that that will slow inflation.
Well, to that end, do you think we get an economic soft landing next year?
I think it's going to be very tough to achieve that. I think given the rapid increase that we've seen in rates, given the fact that inflation is still well above the Fed's 2% objective, we are seeing very strong services inflation right now. That's being driven by strong wage growth. And so the Fed needs the labor market to cool off. We really haven't seen that happen very much. So I think we see more interest rate increases from the Fed in early 2023. I think we see a further drag on interest rate sensitive industries. And I think by the time we get to the middle of the year, the economy will be in recession.
Okay, so what's a consumer to make of all this? I mean, we've been talking about a recession for what seems like already 7-8 months.
I want to talk about growth, Brad. I want to talk about growth.
Right, and so for consumers who have now mentally had to weather through the reality or the risk of a recession for 8 months until the end of the year, and then until it actually really hits at some point in 2023, what's the consumer mindset going to be like by the time it actually hits?
I think consumers are actually in fairly decent shape right now. Many consumers still have adequate savings given the stimulus programs and limited opportunities to spend during the pandemic. The job market is still very good. Wage growth is still very strong.
But aren't they taking on more debt right now?
Businesses are going to... I'm sorry?
Aren't they taking on more debt right now? Isn't that showing up in how they're spending? That's showing up in the credit card data that we're seeing come across. Clearly, they're looking for alternatives in their mechanisms of spending as opposed to some of that cash.
No, absolutely. But they're starting from a very good point. So although consumer credit quality has deteriorated somewhat, it's still very good. They still have a lot of savings, even though they have spent down some of that savings. And so I think that consumers are, pretty well positioned heading into a downturn this time around. Certainly much better than what we saw, for example, in 2007, 2008. The other thing is that I think businesses are going to be reluctant to lay workers off this time around, given the current tightness in the labor market, and they don't want to be stuck when the economy comes out of recession in late 2023 with not enough workers. So I think that job losses will be fairly limited, and that the downturn is going to be concentrated in housing and consumer spending on durable goods, and then business investment.
Gus, is this going to be the recession that most of us just won't feel? And I'm looking at, let's say, I go to a Starbucks right now, Gus, over the last week, and I was run over by 15-year-olds. The place was packed.
Yeah, no, absolutely. I mean, you were talking about the theme parks, for example, and people are still spending there. People haven't been spending. They haven't been going out because of the pandemic, so they're still spending there. I think that this should be a pretty mild recession. I think this is going to be more like the recession of 2000, 2001, or the recession of the early 1990s that is going to cause pain, particularly for people who are in housing-related industries, people who are in heavy manufacturing. But I think that many consumers will hardly feel this, to be honest with you.
All right, let's leave it there. PNC Chief Economist Gus Faucher, always good to see you. Happy New Year.
Thank you. You too.
All right, time now for our trending ticker. In a growing sea of Wall Street negativity on Tesla's fundamentals and stock price, there's at least one analyst, not named Adam Jonas, continuing to try to swim upstream. Baird analyst Ben Callow is reiterating an outperform rating on Tesla stock. The analyst slashes price target to $252 from $316. Owing to recent comments on the company's outlook from CEO Elon Musk and the potential for softening demand. Callow's revised price target assumes about 127% upside for Tesla stock. The stock remains one of Callow's best ideas for 2023. Wish him well. Coming up, Exxon is gearing up for a new tussle with the EU. Brad is back with the details and other top headlines next.
Welcome back, and here are some of the latest headlines that we're following for you right now. U.S. energy giant Exxon taking legal action against the European Union in an attempt to have the Commission's new windfall tax on oil companies abolished. Now, this tax is imposed on firms that have gained an unexpected financial benefit from circumstances beyond their control, like energy companies, which have recently seen a dramatic increase in their profits from oil and gas due to supply issues caused by Russia's invasion of Ukraine. However, Exxon claims that the EU has exceeded its legal authority with this measure, and it is ultimately counterproductive. The EU, on the other hand, says the estimated $27 billion it would collect could be used to help vulnerable households and energy-intensive industries. General Electric announced plans to spin off its healthcare division into a distinct publicly traded company in 2021. Now, that split is expected to happen at the close of trading on January 3rd. GE Healthcare will begin trading on January 4th, and the new company will also be included in the S&P 500 index, replacing Vornado Realty Trust. Vornado will be relegated into the S&P 500 Mid-Cap 400 there. The S&P Mid-Cap 400, and the move marks a significant milestone for General Electric and its shareholders. The new stock is expected to trade under the ticker symbol GEHC. And some Twitter users encountered technical difficulties while attempting to access the service via web browsers late Wednesday in what seemed to be the first major outage since the company was acquired by Elon Musk 2 months ago. This disruption in service has caused a stir among users, with over 10,000 reporting service disruptions, according to Down Detector. In response, Elon Musk said Twitter was working just fine for him. He later tweeted that there were significant back-end server architecture changes rolled out and that Twitter should feel faster. Saz?
Better work well for him there, Brad. All right, President Biden has picked up a few political wins as the year rounds to a close. Yahoo Finance senior columnist Rick Newman has been compiling a list of those wins. Rick, take it away.
Hey. Yeah, so looking at the three most important political developments of 2022, including things that are going to be important going forward. So I think the most important thing to point out is that Joe Biden had a good year. He got two major bills through Congress on a nearly bipartisan basis. That was the so-called Inflation Reduction Act, which is not about inflation. We always have to remind people it's about green energy. That was mostly with Democrats. But then he got the CHIPS Act, which had bipartisan support. This comes after he got the infrastructure bill, also a bipartisan bill through Congress last year. And I think you could fairly say that in 2 years, Biden has easily mounted 4 years worth of legislative accomplishments. I mean, if you go back to what Trump got done in his 4 years, really only one major bill, which was the tax cut bill of 2017. And that was just a Republican bill with no bipartisan support. So Biden has some momentum going into 2023. Now, interestingly, his approval rating hasn't gone up by very much. So you can scratch your head and say, but Democrats overperformed in the midterms, yet Biden's approval rating didn't go up very much. I'm not sure how to sort that out exactly, but I think that I think more people think that Democrats can actually get stuff done than thought that 2 years ago when Biden was first heading into office.
There was a lot of focus this year as well on the Supreme Court and some of the key decisions that they made going into 2023. Where is the general public kind of stacking up in terms of its own understanding around how the court operates, but also some of the other big cases that are still on the docket?
So I think the big thing that changed with the Supreme Court is that I think clearly more people think that it is now politicized in favor of the conservative majority. The Supreme Court is usually at least a small issue in elections because people care about who's going to be which party will appoint the next justice if there is an opening. I think that is now changing, that people care about policy issues that the Supreme Court is effectively determining. I mean, we saw that with the overturn of Roe v. Wade this year, which I think we have pretty good evidence that was a factor that helped Democrats in the 2022 midterm elections. There's no reason to think that will change by 2024 because the Roe overturn will still be in effect. Abortion bans will be in place in the half of the states that have put them in. We will actually see more evidence of the effects of those abortion bans in those states. There's also another important case coming up in 23. The Supreme Court is going to hear a case from North Carolina about whether state legislatures can have a much more powerful role in determining what happens in federal elections in those states. This gets back to what some state legislatures tried to do in 2020, overturning the popular vote in a few states. And that is going to be a big case going forward. Not clear how the Supreme Court will rule on that. But the Supreme Court, the whole nature of the Supreme Court, I think, has changed within the last couple of years.
If the president was a stock, Rick, do you think he's set up for disappointment next year? To your point, he has had a lot of good wins.
Well, if he's a stock, I think you could say he's undervalued. I mean, if you equate his approval rating with the price of the stock, I'm not sure how you would do it. Can Biden outperform in 2023-24? I think he can, because it's not going to be about legislative battles in the next 2 years. It's going to be about foreign policy. Biden has actually had a pretty good year on foreign policy, clearly asserting U.S. leadership with regard to the war in Ukraine. The United States is the absolute indispensable ally among all of Ukraine's other allies. Ukraine would not be surviving if it were not for U.S. leadership there. Most Americans approve of that. And Biden has a chance to sort of rise above regular politics next year. The other factor next year is whether the Republicans, who are now going to control the House, if they're just going to become a chaos machine that can't stop fighting among themselves in order to get anything done. And the big issue there will be the debt ceiling, whether they get an extension of the debt ceiling or whether Republicans block it, which I think would just help Democrats.
Rick Newman, always good to see you. Appreciate
Thanks,
it.
guys.
All right, coming up, our friend Mark Mahaney from Evercore ISI stops by with his top tech picks for next year. Don't go anywhere.
Six Flags riding into some headwinds as the amusement park operator evolves its pricing and product architecture. However, this turnaround effort is casting some doubts, leading to William Blair downgrading the stock to market perform. Joining us now for more on this and the journey ahead for Six Flags is Ryan Sunby, who is the William Blair Equity Research Analyst. Ryan, great to have you here with us this morning. Okay, so when you think about the changes that need to be taking place, or perhaps should have taken place by now over at Six Flags in order to really elicit that park goership or the park attendance, and then additionally, just the number of people that are willing to spend up on their experience at the park, what do you believe Six Flags needs to do in 2023 to course correct?
Yeah, thanks for having me on the show. Really excited to be here. I think thematically we are still huge believers in experiential entertainment. It's something that we've seen take share over the last 2 decades, and I think will do so coming out of the pandemic here. I think there's reasons for that, right? We've seen changes in technology in terms of how we're sharing our experiences online, and I think that's really fueled the experiential spending and will in years to come. Moving to Six Flags. I think clearly the strategy there is to focus on enhancing the guest experience. And I think that's something that the new management team wants to do. They're doing that with less attendance and higher per cap spending within the park. And I do think that strategy has a lot of merits to it. It's just a tough year to kind of put that into practice, right? So just to kind of put that in perspective, right? We started the year with Omicron. You had the conflict in Ukraine. You had inflation spiking this summer, high gas prices, you had news around the midterms. And so there was a lot of noise for the consumer. And I think that's a hard time to kind of reorientate your brand during that period. So I think when you look, the execution here didn't really match the expectations this year. But I think you have to give management some credit here for recognizing that wasn't working. And they're trying to pivot to some new ideas here, right? So in October, we did see them change their pricing structure a little bit, and they had some success there. I think for us to get more constructive moving forward, we need to see that consistent growth in attendance and per caps, and not a trade-off between those two. And I think we start to see that, then I think we can get more constructive at that time.
We should quickly know we've been following the Six Flags activist situation closely here. Salim Basal, the CEO of Six Flags, and head of comms, Stephen Pertell, were just refusing to reply to our request for comment. Now, Ryan, back to you here. Should Salim just be given the boot? Because a lot of the strategies, sure, he might be trying to fix them now, but it's him that I think just rode the discounting wave perhaps too long and now has Six Flags in this current situation.
No, I think Salim's come in with a different vision, right? And I think you got to give him some time to play that out. They did move aggressively, and I think there's some learnings from that, and I think they'll take their learnings and keep what worked and maybe revisit and enhance what didn't work. But I think there are merits to the overarching strategy there. In terms of the activists, I think that's more around how can they unlock financial value there, right? And so this is something they looked at back in 2015 and 2016 about exploring a REIT structure or looking to do a sell leaseback through the real estate. I think it's gotten a little tougher for them to do that, given some changes in the tax code. But I do think when you look at Six Flags, that it's a tool that they can pull or a lever they can pull if they want to. So I think it gives them financial flexibility. It's maybe not something they need to do today, but it's something they can consider in the future.
I remember during past recessions, the hedge against the prices over at Six Flags or some other amusement parks, but primarily Six Flags, was just showing up with a Coke can and trying to get a discount on a ticket. How do amusement parks perform in an impending recession that economists have continued to forewarn about?
Yeah, that's actually one thing we really like about the regional theme park marketplace. They are able to capture trade up during good times, and then trade down from destination resorts during bad times. So I do think structurally there's a lot to like there. There's also a huge supply constraints when it comes to theme parks, right? It takes a massive investment to build one, and because of that, you kind of have these many markets where one theme park kind of dominates that city or metro area. So I think there's a lot to like, right? I think as air travel has gotten more expensive, the local option is appealing. And so, I think that they do hold up well. When you look at attendance during the last 2008-2009 recession, it only declined mid-single digits there. So there are some defensive natures to it. The part that kind of throws a wild card there is, Six Flags push to kind of premiumize the park here and how that will impact the consumer next year in a tougher macro.
Ryan, is there something wrong with the park internally? Does the food suck? Are the rides boring? Because I look across the pond, or I look down to Florida, in our case, we're in New York, and Disney's crushing it. People are going into debt to pay more to go visit Disney, but they're not willing to do that for Six Flags. What's the problem here?
Yeah, I think there are a couple of things that Six Flags can work on, right? I think one, and this does get into Salim's strategy around declining or suppressing attendance to improve the experience, is there is an opportunity cost to having a guest in the park. And if they're not going to spend, it can still prevent spending from other guests. So I think optimizing that guest mix is important. I also think they could lean into IP in a bigger way, right? You see Disney do that heavily with Avatar or Avengers or Star Wars. Six Flags does have a relationship with Warner, and they do use IP around the Warner superheroes. But it is something I think you've seen other parks lean into even more. And so that could be an opportunity in the future for Six Flags, is to maybe try to enhance their positioning with maybe a better connected IP product.
All right, we'll leave it there. Ryan Sumby, William Blair, equity research analyst. Good to see you. We'll talk to you soon.
Yeah, thanks for having us on. Thank you.
Appreciate it. Starbucks will look to milk more money from its most loyal customers in 2023 before handing them free drinks and food. Yahoo Finance's Brooke DePalma has the details. Brooke.
That's right, Brian. Just to give you the skinny of it, 50 stars is now 100 stars, 150 stars is now 200 stars, and 200 stars now 300 stars. So what exactly does that mean for customers? Well, Starbucks certainly continuing to bet big on iced here. Of course, in previous earnings calls, we heard that iced is now hot. And so iced coffee and iced tea will now cost customers 100 stars, be a part of that first tier stars option there, along with hot beverages. But one thing that customers don't seem too happy about, a free handcrafted beverage, of course, that's a latte or a frappuccino, will now cost 200 stars as opposed to the current 150 stars. Packaged coffee, that's the whole beans bag, coming down a bit at 300 stars. And of course, merchandise also coming down about 100 stars as Starbucks really looks to bet big on mobile pay in order. In the last quarterly results, Howard Schultz, of course, interim CEO, said that drive-through, convenience channels, mobile order and pay drove 72% of total sales volume, and also 55% of U.S. company-owned stores in Q4 had those reward members using the app in order to pay for their beverage. So Starbucks certainly looking to make some changes here. It did tell Yahoo Finance in an email that they occasionally do make these changes to ensure long-term sustainability for the Starbucks rewards program. But of course, bottom line here, customers will be paying more for free beverages.
Look, Brooke, I'm asking for a friend whose name rhymes with lion, Mazi, and he just wants to know if his birthday reward is going to stick around.
Well, Brad, Starbucks here perhaps taking a page out of Dunkin's playbook. The free birthday reward at Starbucks is here to stay. Of course, Dunkin' president telling Yahoo Finance in October 2022 that you now will get 3 times the points as opposed to a free beverage at Dunkin', and that they're certainly thinking about that option, but no updates made at Dunkin'. Starbucks, on the other hand, learning from that huge backlash from customers, and keeping that free beverage option. Also, 25 stars, of course, that's for syrup and milk alternatives. That's staying. The 400-star tier level staying as well. And of course, Starbucks sticking to their roots here. For every $1 spent, you will get 2 stars. That is not changing. All these changes, I should say, will go into effect February of 2023. So certainly if you have some stars waiting, maybe time to cash in now.
Hey, Brooke, while we have you, I'm getting a question in from my friend Brad Smythe. He's curious on, do you think this is a good opportunity for Dunkin'? Because might this be a great market share opportunity for Dunkin', which really hasn't made these types of aggressive changes? Sure, they've changed their rewards program, but this might be a good opportunity for them.
Yeah, well, it's hard to say, Brian, in terms of just Starbucks really sticking to the coffee here and certainly betting big on ice. But Dunkin' certainly coming in hot, I guess you could say, as well on iced beverages. We saw them certainly give a run for their money last quarter in terms of their holiday sales, introducing new and even more iced options. But in terms of rewards, I would say that maybe now would be the time for Dunkin' to walk back on that birthday reward. But like I said before, we heard from the Dunkin' president in October of 2022. Now, nearly 2 months later, no update made to that birthday reward. So I guess we'll have to wait and see. But customers certainly not liking paying more at either places for those freebies.
All right. Excellent coverage there and reporting from our own Brooke DePalma. Tweet at her with a tree if you agree. Everyone, thanks so much for the time this morning, Brooke. Appreciate it. Coming up, everyone, we'll do a deeper dive into the state of tech with Evercore's ISI, Mark Mahaney. That's coming up next.
Big tech has taken a hit this year, with shares of Meta, Alphabet, and Amazon all down over 40% year to date. But our next guest is turning it tactically constructive for the year to come. Evercore ISI Senior Managing Director Mark Mahaney joins us now. Mark, always great to get some time with you. Before we get into some of your picks and thinking on the space, as someone that has been covering tech for as long as you have, what has this year been like for you? Some of these declines, many investors have never even seen before.
Well, this is that's right. If you started investing after 2008, this would have been the worst year you'd ever seen. So that's the last year in which you had consumer tech trade off as aggressively as it did in 2022. I mean, there was a series of factors that are all well known now: aggressively rising interest rates, inflation, softening economy, foreign exchange working against kind of the major multinationals. Maybe a little bit of regulatory risk in there. So there was just this really nasty cocktail of factors that came together that really undermined tech growth stocks in 22. I think some of those factors have changed, and certainly it's reflected, I think, in where estimates are and where multiples are. That's why we're more constructive, but we're tactically constructive. I don't want to be too nuanced about it, but we need to be, because softening demand trends are going to mean decelerating revenue growth and pressure on margins for the next couple of quarters. So that makes it very hard for stocks to outperform. You have to be very selective to find winners in that.
Can tech rebound without a Fed pivot or at least a pause?
I'm pausing on your pause question. So I guess the answer is no, it can't. But it's the magnitude of the move, and so going from 0 to expectations of 4% plus, 4 to 5%, like that's a massive move. And going from here going forwards, I just don't think the interest rate shock is going to be as great as what we had this last year. So that's sort of the answer to your question. I think if rates keep rising and the Fed remains hawkish, it's going to be very hard for growth tech stocks to materially outperform. I don't think they would underperform in the way they did this year. So maybe that's the right answer to your question, Brad.
Mark, are some of these tech stocks, these big cap tech names, second half 2023 plays? Because you would have to think comparisons year over year, sales earnings will be much improved, and we might finally get that reacceleration in growth rates.
Well, that's the hope that's in the market. And so, and that's kind of how we're framing some of these names, like especially Amazon and Google that we look at. I think Facebook, the story, the setup on the stock is a little more interesting for the first half of the year, just because, look, you need to, we've got softening demand trends across the board. What you need are companies that are taking cost actions. They got to tighten the belt like all households do. When revenue trends weaken or income trends weaken, you tighten the belt on costs. Facebook did that with a 13% RIF. Amazon and Google haven't done that, especially Google hasn't done that at all. So that's going to cause problems for them in terms of they're going to see more margin pressure than I think is in street estimates. You got downside risk there. Amazon's also going to have some issues. I think they probably need to get a little bit more aggressive on costs. So yeah, I think for the mega cap names, it's going to be tough. Those aren't in my top picks, except for Facebook. The real top picks for me going into this next year for a variety of reasons are Netflix and Uber.
You mentioned Amazon, Mark, real quick on that name as well. Tough year for them, notably. How much time do you think Andy Jassy has here to get things correct?
Oh, I think he's going to have a fair amount of time. So what we all need to ask ourselves is: are the challenges these companies facing, are the challenges that Amazon's facing, are they structural or are they cyclical? And, structural, is there something really fundamentally changed about online retail? No. Cloud computing? No. Or the new competitive dynamics? No, I don't think so. Those are all highly competitive spaces. But the advantage that Amazon has is that it's the leading online retailer. And I think at the margin, they're gaining share. Cloud computing, I think they're maintaining share. They still got this great product mix shift or revenue mix shift towards higher margin, faster growth businesses, advertising and cloud computing away from retail. So I think the core thesis on Amazon is well intact. It's just that it's fully exposed to all of the consumer softening spend, especially in consumer discretionary items, and then inflationary pressures. And the one that's really going to persist from earlier this year are the higher wage costs, and they're going to have to scale against that. So it's going to take time for the Amazon ship to kind of right itself, but it will right itself. And I think if you're, depending on how long term your time horizon is, if you're willing to look out more than a year, I think Amazon's a good price point right here. I think it's at a 5-year trough multiple. But if you want to perfectly time it, which is probably not a good thing to do, but if you're trying to do that, maybe you're waiting until a little bit later in 23 to do that.
And so with that timeline, does high growth internet still have the same type of teeth as it did over the past several years in leading the bull market that we had just come out of?
You're asking a really good, thoughtful question. It's the billions and billions of dollar question. I think some of these names do. I don't think anything's really fundamentally changed about Amazon. Again, is there something structural or is it something cyclical? There are some structural issues, however, with Google and Facebook. I mean, there is the rise of TikTok. Now, there's an open question about what's going to happen to TikTok and whether it as an asset or as an app continues to exist in the U.S. within the next 5 years. That's an open question. That wasn't an open question 6 months ago. It is now. So maybe that risk is somewhat hedged, but there's greater regulatory issues and then these Apple privacy changes. So there have been some structural challenges thrown down to Google and Facebook. Google probably is able to better overcome them than Meta will or Facebook will, but I bet you Meta does too. And what I find so interesting about Meta, just as a stock, is the risk reward here just seems highly asymmetric. The stock's trading at around 12 times GAAP earnings for an asset that I think is going to recover to 20% growth. It's already high margin business, 30% plus GAAP operating margins, generates a lot of free cash flow. I just think you're going to have a major re-rating in Facebook or Meta stock. I don't think it's the next Yahoo. So that's kind of why, hope I said that right. I think that's why it's one of our top picks.
We usually add a few more O's on and kind of a little bit more inflection with the voice, but that's okay. We'll let it slide for today, Mark. I did circle two words within your notes, and it was healthy bifurcation. So perhaps you could take us into like a little Yahoo U on that, if you will. Just this concept of healthy bifurcation and how you see it from your lens.
Well, look, in the first half of 22, all tech stocks, or at least all internet stocks, traded off the same. It was about 50% year over year. 50% decline in the first half of 22, regardless of whether you're big cap or small cap, high quality asset or low quality asset. There was no bifurcation. There was no opportunity really for stock pickers. In the back half of the year, you've had some pretty massive outperformers: Netflix, Etsy, Uber, Pinterest. Now, for a couple of different reasons, whether there was activist involvement or cost steps being taken, or in the case of Netflix, there's this new advertising-supported streaming service coming out. Uber reached free cash flow inflection for the first time ever, and then did it again. They had positive free cash flow for 2 quarters in a row. So there were company-specific factors that caused those stocks to outperform. That, to me, is quality bifurcation. That tells you it's stock pickers' time. That's a good thing. That's a good setup for 23. So you're looking for names that are somewhat recession resilient. I don't cover defensive stocks, so somewhat recession resilient is about the best you can get. That maybe have a new product line and have already taken cost cuts. And I think Netflix kind of fits this bill so well. Recession resilient, you were just talking about Six Flags before. You want inexpensive entertainment? How about $6.99 for 1 month of Netflix? By the way, both of your prior commentators, I think $6.99 is about the cost of a grande latte or something like that with sprinkles. You can get the whole month of Netflix for that. So that should be somewhat recession resilient. It is a new product line. I think they're expanding their value proposition. More people are going to sign up for Netflix because you've got broader range of price points, including cheaper ones. And then finally, they did take cost cuts earlier in the year, and they didn't as aggressively overinvest post-COVID. That's why I think Netflix is so interesting here. And this is the first year, 22 was the first year you could ever buy Netflix on a GAAP PE basis that was somewhat close to the market, so market multiple. So that's why I find the setup on Netflix so interesting.
Mark, I do have to correct you there. Our producer's order, I think, is pushing about $10. They get extra caramel and sprinkles, but that's just our case. We have a very thirsty team here in the morning. I will follow up, though, on Netflix. Are investors just too pessimistic? Is now the time to be aggressively buying this name into next year ahead of what looks to be several positive catalysts?
Well, I think so. I mean, it's our top pick. So what could go wrong? So look, I'm a big bull on Netflix. I upgraded this a couple of months ago. I downgraded at the beginning of the year. No, I didn't call the top. No, I didn't call the bottom, but I'm trying to catch the meat of the moves. And I just want to step back. Like what we've known out of Netflix, having covered this company for almost 2 decades, or even longer, and then watching rising price sensitivity, like their price actions, taking that a 30% reduction in their basic Netflix subscription price, that addressed a real issue. There was rising price sensitivity amongst Netflix subs. And then the math on this is they can actually cut their price by 30% and generate more revenue per user. You rarely see that in business history. I mean, I've yet to find another example. I'm sure it exists somewhere, but this is it's a very rare opportunity when you see a business be able to do this. And I know the stories have come out about how they had to give some of the cash back to advertisers because they couldn't meet all the demand. Stop. That's a really positive thing. They've got so much advertiser demand that they couldn't fulfill it. So the advertisers are there now as they start marketing the service. And by the way, if their core users just stick with the current plans because they're happy with that and keep growing off that, that's a good thing too. So there's so many wins here for Netflix, and I think it's a very good management team. They were probably too late in rolling out the ad-supported business, but that's the past. Going forwards, this service is up, it's running, and then they're also going to be cracking down a little bit on password sharing. I think a lot of us could probably know somebody, have a friend of a friend who kind of shares the Netflix account, and so there can be opportunities to slightly increase monetization. I think there are catalysts. I think valuation is reasonable. We've had a big run in the stock. I grant you that. But I think estimates will go up, and I think the current multiple on the stock can hold, and you can make money that way. It's our number one pick.
Well said. Evercore ISI Senior Managing Director Mark Mahaney, always good to see you. Thanks for coming on all year. We'll talk to you next year.
Happy New Year.
Appreciate it. All right, will 2023 be the year of M&A? We'll discuss next. Companies took a cautious approach to M&A this year with good reason. Rising interest rates raised the cost of borrowing to less attractive levels. Potential targets became less sexy as growth rates slowed, and there has been a general black flag hanging over any deal in the form of a possible recession. So will 2023 be any different for deals? Emily Feldman, professor of management at the Wharton School, joins us now. Emily, good to see you. So how different will next year look, if anything?
Hi, good morning. Yeah, I think it's going to be quite similar, at least for the foreseeable future, right? I think at least through the first half, sort of given the environment, the uncertainty around where interest rates are going, the volatility in the stock market, geopolitical factors, it's sort of hard to see a quick change when the calendar turns. So from that perspective, I think we're in for more of the same, at least for a little while. Obviously, we'll see how things evolve in sort of the second half plus of the year, but that's at least my prediction for the short term.
What does that mean for SPACs? This is the entire kind of construct for how some companies were able to tap into the public markets. And it was really via the deal making that took place. A shell company that would go public, and then the de-SPAC and the acquisition of some smaller prospective company that was really kind of targeted as part of the shell company going public.
Yeah, it's an interesting question, and I think there's two factors, right? I think obviously the market conditions are affecting this, right? In terms of the attractiveness of this this structure, right, of SPACs in general. But then also, as we're sort of seeing, sort of a tightening environment, perhaps for the entities that might be SPAC worthy in the first place, as things get more difficult from that perspective, that could also be a challenge from the input, right? There was just an article that was saying that this was the greatest unwind of SPACs that we've seen basically in 5-10 years, right? So I think from that perspective, it's a contributor as well to sort of the broader M&A market. But obviously, there's a big difference between sort of SPAC transactions versus sort of large corporate deal making that we typically think about.
And Emily, this year really, I would say, is the year of, or has been the one of divestitures. Kellogg, of course, going through their restructuring process. GE, we're talking about GE Healthcare getting ready to be spun off in early January. Will we see more of that next year, especially if we get a recession?
Absolutely, and I really think that this is actually the trend to look out for in the coming months, right? So yes, we've seen a ton of this activity already, and I would argue that that's not necessarily as much linked to sort of the macro environment and the conditions that we're facing. But now that things are tightening so much, right, I think we can expect to see this. And there's really two key drivers here, right? So one factor is, of course, the fact that liquidity is going to be much more constrained, and so divestitures can often be used as a source of liquidity for companies depending on how they're structured. So that's one big factor that should prompt more divestiture activity. But the other is, sort of a broader issue, which is that, when conditions tighten, the value of focus within organizations becomes even more significant. So you have a company that has a lot of different business units. What's your core? What's your strategy? Where are you investing your capital? Where are managers and executives spending their time and attention? What's really central to the company's strategy becomes a really critical question. And so one of the big reasons that divestitures are valuable is that they can help companies to achieve this focus that is especially important in this kind of environment. So for both of those reasons, right, the liquidity and the focus arguments, I would say that we should really be on the lookout for more of these transactions in the coming months here.
Valuable insights from someone who literally wrote the book on divestitures, Emily Feldman, professor of management over at the Wharton School. Thanks so much for taking the time here with us today, and early Happy New Year to you as well.
Same to you. Thank you so much.
Definitely. Guys, coming up, the happiest place on earth issuing a behavioral warning. We're going to discuss that next. Here we go. Time for Cup of Time. 3 stories, 1 minute each. We start with this. The happiest place on earth is issuing a not so happy warning. Disney is urging Florida and California park attendees to be the magic you want to see in the world after in-park fights began to escalate and warned of the consequences to unruly behavior. All right, so brouhaha stirring in Magic Kingdom.
Brian, imagine if you're in line at a Disney ride, you just paid $10,000 for a trip and you get punched in the face by somebody who tries to cut you.
Is that what's happening?
There's been brawls out there. You've seen these videos starting to pop up on social media, hence this warning from Disney. But who would have thought Disney would be a dangerous place to visit?
Who's throwing fisticuffs, waiting in line just to get on Magic Mountain or whatever, Splash Mountain? I mean, at the end of the day, you go there to have a great experience and pay for some overpriced concessions. And
yeah, I think at this point, I'm just going to Disney if I were to take a trip there. Of course, not to get punched in the face, but to see Bob Iger. Maybe he's there. Maybe I get to take a photo with him and ask him about his turnaround plan. I'd be very excited to see Bob at Disney.
I'm sure he's in Epcot, just hanging out, chilling, trying to turn everything around and make sure that they are charting that kind of new path to leadership in the future. But at the end of the day, bring your boxing gloves to Disney, I guess.
All right. Shaq is coming to a VR headset near you. Meta's VR and social platforms will produce a 1-hour New Year's Eve special hosted by the former NBA player, which will include performances from Cardi B and Ludacris and play on a loop all night. Brad, maybe this is the thing that gets me to buy one of these glasses. I don't know. I love Shaq. I love Cardi B, and I definitely like Ludacris. I don't know. I'm on the fence.
I mean, they're all high-profile names. Who doesn't love Shaq? And at the end of the day, if there's somebody who's going to get you to at least see what the metaverse looked like, there's a very short list of individuals, and Shaq is one of them. He's on that list for sure. Now, I mean, people have their own individual, but I think in the AR and VR reality that Facebook, or Meta Platforms rather, is trying to build out, and what that could look like, it's going to come down to the events and also the ticketing, what they can charge over an extended period of time to ultimately net a profit and see some revenue come in from this. But perhaps a good starting point, or at least a taste of what viewers can expect.
And we're told that he's going to be DJing a set under his DJ name, DJ Diesel.
Yes.
Maybe I will get these.
That was Shaq Diesel, yes.
Yep.
All right, this one's me. Loyalty is paying off for one Burger King worker. The fast food chain gave employee Kevin Ward a goodie bag for never missing a day of work in 27 years. A goodie bag, folks. But viewers of the viral video, they're taking matters into their own hands, raising over $400,000 on GoFundMe. Great to see when the community of people who want to have it their way come together and make sure that this one worker gets to have it their way in whatever they choose to use that $400,000 towards.
A goodie bag. But this really, I think,
that's sad.
Highlights the model of some of these companies. They're all franchises, franchisees owned for the most part. And sometimes the franchisee owner, they don't get it. They normally don't get it on food, marketing, you name it. I can't imagine this would have happened if it was a corporate-owned store, but nonetheless, it's good to see, to your point, the community stepping up here and giving this person what he deserves.
Oh yeah, spot on. I mean, you wouldn't imagine this happening. I don't believe at, say another large chain. I mean, sure, there's the quick service restaurant side, but then the other major retailers, Walmart, Target, they've taken leaps and bounds, even Starbucks, to try and just make sure that there are more perks for their employee base as well.
Good to see it. All right, coming up, Brad and yours truly will reset the show with a host of fun guests on tap. We'll speak with an early investor in Elon Musk's SpaceX and get the details on 2 new ETFs that may be amazingly great additions to your portfolio next year. Don't go anywhere. We'll be right back.
With the egg.
Welcome to Yahoo Finance. It's 11 a.m. on the East Coast and 8 a.m. on the West Coast. I'm Brian Sozzi alongside Brad Smith. Here's what we're watching right now. Better late than never. Just when you thought we were slumping into the new year, the likes of Apple and Tesla shake off big days of losses and push stocks into rally mode. Have fears over China's reopening been overdone? We'll discuss. Diamond hands no more. Bitcoin's biggest bull does what he said he'd never do. He sells some Bitcoin. We'll ask if this is all part of Michael Saylor's grand strategy and if the wider crypto sphere needs a Fed pivot to have a strong 2023. And space stocks to the moon. Not quite this year, though. Big successful launches and major players like SpaceX pushing the envelope. Is there enthusiasm for the final frontier in 2023? We asked top investor Chad Anderson. But first, let's get a check on the major indices here. As we just highlighted here, we're seeing a little bit of a rally here, Brad. The Dow up more than 300 points. The S&P 500 and Nasdaq also in the green, gains accelerating throughout today's session.
Yeah, some of the sectors we've been tracking as well on the day. In fact, all S&P 500 sectors right now up across the board here, led right now by one name in communication services, but also technology and consumer discretionary really leading the pack. All of those averages, including real estate, up more than 2% on the day.
Quickly mention Apple up 3%. All right, we're starting off this hour with the latest in the FTX saga. $200 million were taken from customer funds by the crypto exchange to fuel venture capital investments, according to the Securities and Exchange Commission. Meanwhile, Michael Saylor's MicroStrategy has sold Bitcoin for the first time, something he said he'd never do, citing tax reasons for the move. Though the company remains a net buyer, the sale did raise some eyebrows. We spoke with him last month in the wake of the FTX collapse.
I think that this is going to be really helpful for Bitcoin because this is an educational moment and people are realizing the benefits of buying a crypto asset that's backed by the world's most powerful computing network and by 10 gigawatts of energy. And the difference between that and the 20,000 other cryptos that are in essence backed by nothing, and they're just like other fiat currencies.
To dig into all this, we have Yahoo Finance crypto reporter David Hollerith here. David, hit us with some analysis.
Yeah, Brian. So in regards to Michael Saylor's comments and MicroStrategy's recent disclosure, the company bought roughly $42 million in Bitcoin at the beginning of November through December 21st. It then sold 704 Bitcoins. And a day later, it bought back 810 Bitcoins. That was December 24th was the last transaction. So, what to make all of this? It appears that MicroStrategy, according to their disclosure, was doing a tax loss harvesting strategy in which they bought Bitcoin and then sold it partially and then bought it back again as a way to use the losses from the middle selling period to offset their capital gains tax for the taxable year. Now, obviously, as Saylor has pointed out, the company is meant to acquire Bitcoin and hold it for a period of time. It looks like in terms of the tax season, that doesn't exclude it from making tax loss harvesting strategies as a way to shore up more cash. MicroStrategy also disclosed in that same filing, which came out on Wednesday, that during a period between October 1st and December 27th, it had raised an incremental $46 million after selling more than 218,000 shares of its common stock at $213 per share. Now, the stock is down 75% year to date, and it's trading now at $142.
Wow. Okay, so we've been tracking this pretty closely, as we know you will continue to as well. David Hollerith breaking all of this down for us with MicroStrategy's sale, but additionally some of the crypto market moves that we've also been tracking. Speaking of market moves, let's turn now to the broader markets to set the scene for 2023 performance expectations. As the new year approaches, joining us now, we've got Michelle Connell, who's the Porsche Capital Management owner. Michelle, great to have you here with us, and an early Happy New Year to you. A year that many investors want to put behind them in 2022, and now looking squarely at 2023. Where should we be finding some sources of perhaps optimism for 2023?
Well, first off, thanks for having me on, Brad, and Happy New Year to you and all investors. I'm still, despite the tape looking, a little bit more optimistic today, looking out at least through the first half, definitely the first quarter, I'm still a little bit cautious here. I think we're going to be looking at more softness from a consumer, and that means that we're probably going to be looking at softness when companies come out and report first and second quarter, and you're going to see revenues probably down and margins taking a little bit of a hit here. So I think that we still have some tough waters in front of us, the beginning of the year at least.
Michelle, on the cautious part, where do you think the landmines are going to be this earnings season? What sector is really going to surprise investors negatively?
I think it will be the areas where consumers have the largest impact. That will be maybe even consumer staples, consumer discretionary. I think as you're seeing more people trying to keep up with inflation by tapping out their credit cards, we saw that at the end of the third quarter, a $40 billion increase. That's huge. And people are starting actually to tap, taking hardship withdrawals from their 401ks. And you look at all that combined, and also with how heavy portfolios have been hit, I think people are going to get through the Christmas and holiday season and start looking at their investments and going, okay, what now? So I think people are going to take their time wading back in and taking risk. So consumer discretionary and consumer staples, I think you're going to see softness there. I still like energy, and I think bonds are a good area to start looking at. No, there's no harm in getting 7% in, some good, strong bond funds, and while you're waiting to take on more risk.
When your customers reach out to you and clients want to have a conversation about where they should stay invested right now, what have you been advising them?
I've been fortunate because it's an education process with your clients. You always are reaching out to them and telling them what's going on and where you are seeing some potential opportunities as well as risks. And clients want to know that they are protected from more downside at this point, and that they're going to be able to make their retirement goals especially. And so they want to make sure that what they've saved up to this point, there's not going to be any more damage. So talking them through the strategies and also trying to steer them away from being more short-term focused, which all of us are as human beings, to more long-term focus and, the end game, what they want to accomplish.
When we think about the number of people who are set to retire in 2023, how does that really impact the equity markets as well, if they're starting to pull some of that off the table in order just to make sure that additionally, at least on the onset of retirement, that there is enough cushion for themselves?
You're having more individuals that are near retirement who are, wanting to go to more safety in their portfolios. Individuals either want to go towards more bonds or more real estate or even cash. So you can't blame them at this point. And you even have individuals, I've had people come back to me and say, do I have enough? Am I going to have to go back to work? These are individuals that are either retired or close to retirement. And so these are things that individual investors are really concerned about going forward. How are they going to meet these goals, especially if these goals are necessary in the near future?
Michelle Connell, Porsche Capital Management owner. Good to see you. Have a happy new year.
You too, Brian. Thank you.
All right, let's quickly highlight a Yahoo Finance trending ticker before we head to break. We continue to watch Bed Bath & Beyond. The company's ticker page saw increased interest late Wednesday afternoon and into today on comments made by Luke Capital analyst Anthony Chikamba on Yahoo Finance. Chikamba pulled no punches, telling us he doesn't think Bed Bath & Beyond will be around for holiday season 2023 amid a host of financial struggles.
Coming up, everyone, Santa has come and gone, but there's still time for a rally. And what happens in the first quarter if we don't close out on a high? Yahoo Finance's Jared Blickery here with an update on the other side. The Christmas holiday may be over, but whether Wall Street will make it into Kris Kringle's naughty or nice list is still to be determined. Yahoo Finance's Jared Blickery is here to tell us whether a Santa Claus rally is indeed coming to town. Jared.
All right, well, let's take a look. This is the statistical history of the Santa Claus rally going back to 1950. And technically speaking, it's the last 5 trading days of the last year, of this year, and the first 2 days of the next year. So given those 7 days trading history, you can see it's mostly green, a few red spots there. And so it's out of the norm to actually have losing returns over this period. So let's take a look at what's happened so far. This is the Dow, and we're going to look at 4 days into the Santa Claus rally. It goes back to last Friday. Up a whopping 38 basis points, a few hundred points there. Nasdaq actually still underwater, but less than 1%. And the S&P 500 up, but less than 0.5%. So kind of sideways trading action so far. Let me go back here and talk about the importance of the Santa Claus rally with respect to January, because when you take the Santa Claus rally plus the January returns and you add in the first 5 days of January, if all of those are positive, it points to a positive year overall. So that's a pretty important prognosticating tool here. Now, as far as January is concerned, if you go back to 2000, it doesn't have the best track record. A little over half of the time, it's actually negative. However, when you look at the presidential cycle, so we're going to be in year 3 starting in January of the 4-year cycle, much better odds. Going back to 1950, the Dow is actually, January is the best month, or the second best month. It is the best month for the S&P 500 and the Nasdaq. And you can see the returns go from about 4% here in the S&P 500 and the Dow to up to 7% in the Nasdaq, and up many more times than it is down. So good to see that. The reason Nasdaq and the reason Nasdaq doesn't have as much history, it began in 1971. So all told, January and the Santa Claus rally, we're still in December, has very important prognosticating power for what portends in the new year. All of that to say that the presidential cycle is a tailwind. That's about 30% here of potential gains in January. If that comes true, well, we probably got a nice year on our hands in 2023. It'd be a welcome respite, I would say, from the current year, guys.
Most certainly. Jared Blickery, thanks so much. All right, we are tracking 2 new ETFs that just launched with a climate angle. The first is the Subversive Decarbonization ETF, and the other is the Subversive Food Security ETF. Let's talk more about both with Christian Cooper, a portfolio manager at Subversive Capital. Good to see you here this morning. Why launch these now?
Well, it's an interesting time in the world, to be frank. We have, I think the real trade of 2023 is going to be, with respect to decarb, trading rich dollars for cheap fertilizer. And what I mean by that is we have a war in Europe. We have the bread baskets of the world are fighting. And you can really use those dollars, the appreciated dollar, to acquire some of those cheap global assets around a trade of around PE of around 7 or 8. So I really do think that's going to be one of the more important trades in 2023, but all of these kind of fit within the same geopolitical theme.
And so one of the sector within this, and I was looking at your sector breakdown, that really stuck out was the agricultural inputs. And how do you really kind of evaluate and qualify some of the companies that you look across within that subsector?
It's really interesting if you look back at what happened during the Arab Spring, and that is kind of our model for how the world of food is going to behave going into the next year, especially if we see negotiations break down between Russia and Ukraine, if this drives out for another year. So we have built the portfolio to acquire cheap assets within the fertilizer space and then build on top of that. What does the food chain look like? What are the vertically integrated companies that we like in that space that are going to offer real value? Because as we all know, it's not the best idea. It is the best trade, right? These companies still have to trade well. And I am worried about valuations going into 2023. I am worried about the front end of the yield curve. And so as I look for value, that's the best place to find it, I think.
Christian, I just want to make this as simple as possible to our viewers and the investors on our platform. So the food ETF, is there another way to look at it? This is a play on things just in the world going to hell in a handbasket next year.
Well, it is a nice rally underway to this morning, but I'm not certain it is going to last. And I do believe that there are challenges and risks to the world that are not being priced. And food security is one way to hide, for lack of a better word. Taiwan has just increased their military service from 4 months to 1 year. You can train someone to use a mop and a bucket in 4 months. You can train them to do a lot more in a year, right? There are remilitarizations in Germany and Japan that are probably going to define the next decade. So hell in a handbasket, I hope not, but preparing for the worst and looking and using those rich dollars now to buy those cheap assets. I think that's really the key to what we're trying to express with this fund.
And then going back to the decarb one, Tesla shares have been in a lot of climate-friendly ETFs, and considering how the valuation has come so far down this year on the name, any interest in adding Tesla?
No, no interest in adding Tesla, mostly on a valuation basis, and I think it's well managed. I think their technology is great. On a valuation basis, I just can't, as a portfolio manager, am I going to own Tesla at the expense of the entire rest of the industrial, the automotive sector? I think there is a bit of a mean behavior there that, in my mind, is not justified. So I want to see, and also not to belabor the point, but to get back to the China risk, I think this is not inconsequential going into 2023, and I think there are geopolitical risks that are not being priced in for Tesla at the moment.
You also have an ETF that's shorting Meta, and I assume as a part of that, the metaverse, which there's been so much capital that has really been thrust towards making that reality real. But there's so much still that has yet to come in the terms of development, in the terms of the number of users that are going to be necessary for it to be profitable in the future as well. And so walk us into your thesis there.
I fundamentally believe that Facebook has missed what the metaverse is, right? Like if we think about what is next for the internet, it is about identity, it is about ownership. Some elements of that are in Web3 and are fairly well known. It is not what we have all seen, though, with this cartoonish imagining of a conference room, right? That's not where kind of value is going to be created in this space. So that was the first idea of the short. But the second idea is, okay, where are we going to see value? If you think about your phone and how you interact with your phone, especially the haptics, right? That little subtle feedback mechanism that we're all used to now, that still exists. That also exists in the industrial scale, right? If you look at Agilent, one of our top holdings in Punk, it is looking at how we can get the industrial supply chain in to communicate with our devices. And there's every type of testing mechanism that they are working on. So I just don't think Facebook is making the right bet, and they seem to be committed to spending billions more on this bet. And they're also going to take a hit on where the front end of the yield curve goes into 2023. It's just going to be a tough time and I will remain short into next year.
Subversive Capital Portfolio Manager Christian Cooper, thanks so much for joining us here this morning. Interesting conversation and some components that we're going to have to track going into next year as well and beyond, quite frankly. Thanks so much. Appreciate it. Guys, coming up, reading the DC tea leaves. The House changes hands, student debt is in limbo, and then there's Title 42, funding for Ukraine, and inflation. So what's in store for the year ahead in Washington? We discuss next. Yahoo Finance investors were polled and gave us some of their predictions for the markets into 2023. And then there were some intriguing ideas about who will make and lose money and what might be different by the end of next year. So here to break down some of those responses, we've got Yahoo Finance senior columnist Rick Newman. Take us into the Numaverse and what we got in some of these responses.
Yeah, we got thousands of responses. So we've asked some basics about where do you think markets will be, where do you think inflation will be next year. Our audience expects modest improvements in the S&P and the Nasdaq, single-digit gains there. In general, our audience does think we're going to have a short and mild recession at the beginning of the year, but they're very optimistic about what the end of the year might bring. So in addition to just asking things like where do you think inflation is going to be, the stock indexes, we asked just an open-ended question, blank sheet of paper, fill in the blank. Tell us what do you think the big story, the big business and economic stories will be next year. And then I scanned through almost 4,000 of those to figure out some of the recurring themes. And I've got a couple of them for you here. So first of all, lots of our audience members think the second half of the year we're going to see a nice bounce in stock markets. We're going to be beyond whatever the little itty bitty recession is that comes at the beginning of 23, and inflation will be under control. So maybe around 4% or so, let's say. So that is a pretty good scenario for markets, I think, as long as it seems like we're finally going to get to the point where interest rate hikes aren't determining everything.
Rick, yeah, all that work paid off. This is now on the top 10 most viewed or looked at or read stories on Yahoo Finance right now. So hat tip to you, Rick.
Well, hat tip to our audience because they actually we have very smart readers,
yes,
and I like to know what's on their mind a lot of the times.
Where are they thinking about on tech stocks to that point? I mean, a lot of these viewers and investors on our platform, they log in, they check Apple, they check Amazon, Google. Yep. These are the only stocks they have historically owned, and they've all been battered this year. Yeah.
So another recurring theme in this open-ended two I'll give you here. So I've got 11 predictions I put together on a story that's on the site right now. But we do have a significant number of Yahoo Finance people who think big tech will make a comeback. The big tech play is not over, even though the Nasdaq has gotten hammered this year more than the broader stock market. But they say, look, Apple's dominance is not over, Microsoft's dominance is not over. And then one other prediction, we just had an investor telling us he's short Meta. I didn't hear him say he's short the metaverse. He said he's short Meta. But we have some audience members who say the metaverse is finally going to catch on in 2023. Now, I think it depends how you define metaverse. So I'm not sure you two guys are going to be wearing VR goggles at the desk here by the end of 2023.
Hold on, let me get mine from under
Maybe
the desk.
2025, I don't know. But I like what our investor said just in the prior segment. He said, the metaverse is not necessarily going to be this cartoonish idea where people are sitting around with these VR goggles and somehow they're in a conference room in Hong Kong, that it's going to have more to do with better ways to do social media and stuff like that. And that's actually what I saw in some of these comments, that social media is going to have problems, like look at what's happening to Twitter, and that's an opportunity for the metaverse to come in and offer something better.
As long as we're all not replaced by some artificial intelligence deepfake, then that's perfectly fine, I think.
I guess.
Careers.
I feel like it's coming, but hopefully not next year.
Let's keep that at bay for now. But when we think about next year and kind of bringing together where you continue to cover in what's happening inside the Beltway in Washington, D.C., and where that overlaps in terms of equity markets and just public policy relating to business practice as well. What did some of the readers kind of put together or at least correlate between?
Well, let me bring it back to inflation. Because we saw, in a way, the craziest inflation we saw this year was in used cars. First half of the year, we saw used car inflation as high as 40%. So one of the things that came through in all these open-ended comments was we're going to see the opposite, the mirror image effect in 2023, which is a plunge in used car prices. Perhaps back to where back to levels they were before all this craziness happened because of a new car shortage. So, Saj, you might get to add to your collection in 2023.
This only fuels the debate on our worst company of the year, which you covered, Rick.
Yeah, which was Carvana. Yes. And it's not so much because of what's happening in the used car market per se. Carvana got way too far over its skis, made an acquisition, took on too much debt, but also did not prepare for what could be a really sharp reversal in used car sales next year. So a buying opportunity. And then one last one I thought was really interesting. A lot of people think the electrical vehicle revolution, EVs, is overplayed. and that we're going to see the EV revolution stall. It's going to turn out that we're not going to go all the way to EVs as fast as people think. It's the fact that they tend to be expensive, limited range, and rising electricity prices, by the way.
So the return of the naturally aspirated V12.
Or sure. So that's what you're going to buy on Carvana is next year is a Bugatti V12. Okay, sure. That's where I was going with this.
There'll be plenty of them there for you.
But, look what's happening at Tesla stock to end the year. And we're seeing Lucid and Rivian, look at those stocks struggling. So we have a lot of investor-minded, investors using our site who are looking at all this and saying, maybe that's one of the things that's going to happen in 2023. The EV revolution stalls, at least for a period of time.
Well, great stuff, Rick Newman.
Yeah,
really appreciate it. Please do give Rick's story a big read here and a big share. Rick, appreciate it. All right, coming up, this year has seen several high-profile labor union battles, notably against corporate giants Amazon and Starbucks. We'll take a look at if more are in store for next year. Don't go anywhere.
Well, I'm very optimistic. We are very well prepared for the long haul of this battle. We understand the odds that we have to defeat and the odds of getting a company like Amazon to come to the table.
That was, of course, Amazon Labor Union President Chris Smalls. He spoke with us 10 days ago on the prospect of contract negotiations in the year to come. This year has seen several high-profile labor union battles, notably against corporate giants Amazon and Starbucks. So what's in store for next year? Yahoo Finance senior tech reporter Ali Garfinkel joins us with the analysis. Ali.
Hi, Brian. It's great to see you. You actually hit the nail right on the head, off the cuff. These unions are taking on companies that once seemed invincible, and we only need to kind of go down the list to make that clear, right? We have, of course, the Amazon Labor Union and its historic win in Staten Island earlier this year. This year was also the first time that workers at Trader Joe's, Apple, Chipotle, they all voted to unionize. And then, of course, there's Starbucks, right, which accounted for roughly a quarter of all union elections this year. So on one hand, you have unions taking on companies that seemed unstoppable. And though unions are still focused in places where they've historically been most successful, for instance, the West Coast, the Northeast, we've also seen some increased activity even in the South. So there's that happening. And I think part of it is simply a byproduct of unions working their way into the public consciousness again, Brian. 68% of Americans approve of unions right now, which is a Gallup poll that was taken relatively recently. And that's a level of support we haven't seen since 1965. And I think that's also a key component of what's happening.
So what challenges does the union wave face in 2023, Allie?
That's a great question, Brad, because they're far from out of the woods yet. There are a lot of logistical challenges unions face to start. For instance, bargaining. It takes a long time and a lot of resources. The average bargaining period is actually 465 days, according to Bloomberg, and they have to sustain themselves during that time, and they have to retain support during that time. There's also, of course, the macro, right? The union wave could be running face first into a recessionary environment of some kind. We don't know what that's going to look like yet, but the bottom line here, Brad, from my perspective, is if 2022 was the year unions made a comeback, 2023 is going to be the year where, for those unions, the rubber meets the road.
And so amid hiring freezes and, in some cases, headcount reductions, where do some of the union pushes continue to either hold up or lose some of that steam?
We'll have to see, right? I think the interesting part is that we really don't know, because I can tell you what I've heard from workers, and what I've heard from workers is the same message across the board, whether it's Apple, Amazon, Starbucks. They all say this union push is not going to stop because it has already gained so much momentum. That said, when bills come due, we'll have to see if they can keep up the steam, not only among the most gung-ho organizers, but the people who signed along for the ride.
All right, Yahoo Finance's own Allie Garfinkel. We're going to continue to track this very closely, as we know you will as well. Thanks so much for that report. We're going to be right back after a short break. Major averages still holding on to gains this morning. We're a little over 2 hours into today's trading session. Stick around.
It's commonly said that there are two guarantees in life, death and taxes. And if you think it's too late to start tax planning and saving for next year, our next guest says there's actually still time. With us now is Tim Spies, partner at Eisner Ampner. The clock is ticking. What can they do? What measures should one be taking at this point?
Well, right now, and first, thank you for having me. We're helping clients review, for example, their investment portfolios presently, harvesting gains and losses. That's number one. Number two is looking at their forecasted tax liabilities for 2022, but also into 2023 to determine if there should be additional estimated tax payments made or losses or deductions that can be contained. That's number two. Number three, the trusts and estates. We're doing a lot right now, again, before year end regarding the establishment of trusts. I should point out that the repeal of the estate tax exemption as we currently know it is going to be reduced. You might remember that the estate exemption was as high as $10 million. That's resetting, and it's resetting in 2026. So we have plenty of time to help clients plan, but we're still wanting to take advantage of clients maximizing their estate tax exemption. Again, that's per person. That's $20 million for a married couple. And while that sounds like a lot of money, there are many persons that have the capabilities to do estate planning to minimize any transfer tax. So that's a short summary, but we certainly can talk about some of the things we're doing as well.
Tim, additionally here within the tax planning, and especially as we go into 2023, where we know that federal retirees, they're going to see the biggest COLA increase or the cost of living adjustment increase in over 40 years. How does that change where going forward from here they're going to need to kind of adjust on any kind of tax basis going forward? How is that going to look different from them?
Well, let's talk about pensions versus the ability to roll over pensions, if possible, into IRAs or other vehicles where the individual can control the distributions. You probably know that distributions from IRAs commence in April following the year you turn 70 and a half. So we're actually in those circumstances trying to create planning opportunities to defer the distributions. Where distributions have to occur, maybe that age 70 and a half has already been attained. You could try to do non-qualified plan rollovers. You could perhaps try to roll it into some other deferred assets. I could think of life insurance, but that's extremely hard to do. We do have clients that have used life insurance and cash surrender values as a de facto retirement plan. But what you're citing is a real issue, and we're working with many clients to help them resolve it.
Tim, all this is great if you actually find a tax planner or an accountant. And a story in the Wall Street Journal yesterday had us all talking here in our office on how accountants are in fact leaving the profession. I mean, do you see this in your own practice, and where is everybody going and why?
Well, that's a great question. It's a national issue. There are many persons who have left the profession or gone to another aspect of the profession. We happen to work for a certified, or I do, I'm a partner in a certified public accounting firm. There are certainly other jobs where a person can use those skill sets where it doesn't have to be on a CPA platform. But I think you might be speaking about CPA firms specifically. You can correct me. But I would also say that in the accounting industry specifically, yes, there are people that have chose to go into other disciplines for various reasons. It's everything from just keeping up with the tax law to, of course, the job and profession itself. And it's something that we're keeping an eye on because it's very real, and we're doing everything we can, of course, to retain our colleagues and keep them at our firm.
All right, let's see what they are. Timothy Spies, partner at Eisner Ampner. Good to see you. Have a happy New Year.
All right, thank you very much. Take care.
Switching gears, everyone, it hasn't exactly been a to-the-moon kind of year for space stocks. The sector, another casualty of snarled supply chains and a brutal stock sell-off thanks to mostly tighter monetary policy. Space companies that rode the SPAC wave of the last few years facing more than a little downside pressure. On the other side of the coin, it's been a big year for innovation and successful launches like the Artemis 1. Though investment this year has been down, it's worth remembering the hundreds of billions of dollars that have flowed into space ventures over the past decade. The likes of Virgin Galactic, Rocket Lab, and of course SpaceX are now industry leaders. Joining us now is a man with a lot of skin in the game. We've got Chad Anderson, who's the managing partner of Space Capital and a SpaceX investor as well. Chad, great to see you here to really cap off 2022. We were just running through the kind of moves that we've seen within the space industry, both for privately traded companies and for some of those that have made their way into the publicly traded realm. They've struggled out of the gate this year, as many of the SPACs have, and the class of 2021 has as well.
That's certainly true. I mean, SPACs are a story in their own right. I think, thinking about where we are and where we're going in 2023, recapping 2022 pretty quickly is a good place to start. So, I mean, in the first half of the year, the Russian invasion of Ukraine really showcased the growing commercial capabilities of commercial space companies. So SpaceX's Starlink satellites kept the Ukrainians connected and helped them combat Russian misinformation. And Earth imaging companies like Maxar, publicly traded, Planet, SPAC company, publicly traded, were providing ground truth, what's actually happening on the ground to, again, combat Russian misinformation. And they're providing essential information and insights to enterprises and governments, which they're willing to pay for. The NRO, one of the big 5 U.S. intelligence agencies, made their largest ever purchase of satellite imagery in Q2. And record revenues for these Earth observation companies like Planet are really showcasing, how data and insights from space-based assets are really essential. So,
one of the interesting things that we've heard cited going into 2023 is this kind of overhang of geopolitical tensions. What does that mean, or what does that translate into some of these space ventures that have come to light over the past few years, and in investment accelerated fashion too?
Every space technology in existence was developed by the government for the government and military purposes. I mean, think about GPS is the original space technology and the most successful in history. It's generated trillions of dollars in economic value and some of the largest venture outcomes we've ever seen. And that was built by the government for the government and military purposes. Earth observation is the same situation. We wanted intelligence about what was happening in different areas. It was used for Earth science, for government programs to understand what was happening on the surface of the planet. And then eventually, it became to grow into a commercial market. The same thing's happening through all aspects of the space economy. You mentioned, the Artemis program, and that's another great example of one that we're on the front end of.
What do you think next is for SpaceX?
2023 should be a very big year. They've just started launching their next generation Starlink satellites. These have optical inter-satellite links, so you can think about it as a mesh network, an internet backbone that's in orbit, that is a redundant internet backbone to the Earth, providing new capability, new capacity to all corners of the planet. And this is going to enable all types of new applications from enterprise, government, defense, and consumer. And also, obviously, their other big program is their Starship program, and we're hoping to see Starship get up in an orbital test launch early in the year.
And we had already seen, as of, I believe, late last week, over 59 launches, and there were still 2 more for the Falcon 9 that were planned before the end of the year. And so, I guess that would have happened by now, or perhaps today or tomorrow. Yeah. And so what does the pipeline for the launches look like in 2023?
Yeah, so they've broken that number. I think they're at 60 now. So more than 1 launch per week. That's SpaceX alone, let alone globally. This was a record year for launches, commercial and government-driven launches. We have new vehicles coming online next year. So SpaceX's Falcon 9 has really dominated the market. It's the best, most cost-effective, safest, most reliable vehicle that exists. And next year, we're going to see more launch vehicles come online, several of them that are going to be increasing competition for the space. But Starship is in a class of its own. The biggest rocket we've ever seen, the lowest cost, fully reusable, rapidly reusable. You can think about us moving to the era of expendable launch vehicles, moving into a realm of more like commercial jetliners.
Are you concerned on what SpaceX may or may not do, just given Elon's everything that's happening with Twitter? We've seen Tesla shares sell off very aggressively because of what may or may not happen to Tesla. Do you share that concern for SpaceX?
No. So Twitter is clearly a distraction for him and all of us. But the people that are in charge at SpaceX, Gwynne Shotwell, is leading the charge there, and she's been, the lieutenant there since the very beginning in the early days. Elon has put her and Hunosko, two key executives down at Starbase leading Starship development. And so I actually look at that as a positive thing. They weren't making the progress that they wanted to see. They were hoping to get to orbit by the end of this year. That didn't happen. So he's put his best people on the job.
Does the appetite for, you think about the number of space tourism pursuits that were really pioneered in 2021, the likes of Blue Origin, the likes of SpaceX as well, and Virgin. And so with all of that, in a recession, does that just kind of evaporate, or does that kind of crash land, at least for an extended period of time, because of those dollars being spent in a discretionary fashion elsewhere, even by the most affluent people who could afford a trip to space?
Yeah, it's a good point. And I mean, I think it's important to also note that space tourism is a very, very small part of what's happening in the space economy at large. It's mostly about the data that's coming off of space-based assets. And as investors, that's really where we see a lot of the growth. But the space tourism is very interesting. Last year, there wasn't really an opportunity to go, to buy a ticket to go to space. That all changed this year. We saw 30+ private astronauts go to the edge of space and suborbital space, or to go into orbit on a SpaceX vehicle, and to go to the International Space Station as well. So that became a reality this year. And we know there's long waiting lists, and there is actually several orbital missions lined up for next year as well, where we're going to see the first private extravehicular activity or spacewalk in a spacesuit on a SpaceX vehicle. So next year should be pretty interesting from a space tourism perspective as well.
Chad, extremely knowledgeable inside analysis as always. We appreciate you joining us here on set to close out 2022 and the year that has been, but a lot of exciting pursuits still left in the space frontier. Chad Anderson joining us here today on set. Thanks so much, Chad.
Thanks, guys.
And everyone, coming up, who wants to be a billionaire? I mean, look, who's not going to raise their hand? How market volatility impacted global wealth in 2022, though. We've got the details next.
Talk about going into the new year on a pessimistic note. More people expect a recession than at any other point in recent history, as you can see in our nifty chart of the day from Bianco Research. Recession fears are even higher than around the time of the dot-com crash. So much for being cheery into the new year.
Well, it's been a bad year for the rich, with the world's billionaires losing almost $2 trillion altogether in 2022. This is according to Forbes. Tech CEOs were the brunt of the losses. They wore the brunt of the losses as major firms began hiring freezes and massive layoffs. Although Elon Musk dropped to number 2 on the Bloomberg Billionaire Index, he's still the wealthiest person in the United States. Okay, so billionaires lost some money.
I think he's still doing okay. All right, that's it for now. I am Brian Sazian. Well, that's Brad Smith. Have a great rest of the week.
Yeah, taking a look at the markets as we leave you on today's show. We are still higher across the board right now. Dow Jones Industrial Average still up by about 1.2%. S&P 500 up 1.9%. Nasdaq Composite up by about 2.8% here. And then additionally, just checking in on some of the retail stocks that I've been keeping a close eye on here, as it's return season. Buy online, return in store season is here among us.
I only got gift cards. I can't return my gift card.
Well, you got to go.
I got a gas gift card. I'm really excited about it.
That's actually a good gift card to get.
Oh, yeah, definitely. Especially
NRF coming into this part of the season, they had estimated that holiday returns would be about $171 billion worth of returns. That's about 18% of merchandise, 17.9% to be exact, merchandise sold during the 2022 holiday season. So keep a close eye on these names. All of them up, though, as the broader markets are higher, as we just mentioned to you a moment ago. That's it for now. Brad Smith, Brian Sazi. Bye-bye.